at the same time, it's been a problem on the platform for a long time, especially when people use bots. So I'm not exactly sure what his angle is here. I feel like he kind of is not necessarily cut out to run a social media platform. I love that we're more free on the platform. I love that a lot of things have been exposed regarding speech and liberty. But at the same time, I don't necessarily think Elon's cut out for it. And the fact that we're not hearing from the current or new CEO says a lot to me, because Elon was so outgoing. He was so forward. And I feel like this person that's now taken over, she's probably going to embody what corporate America does and just sits back and makes decisions and not practice any type of good communication. That's kind of the vibe that I'm getting. I hope that I'm wrong, but I just don't see it playing out that way.
Do we think that people will now go to alternatives like Blue Sky? I mean, there was some stories over the weekend about that.
No. I finally got my Blue Sky invite the other day, and Ben, thank you for reminding me, because I forgot to accept it. So I'm going to go and do that. Ben, to the sentiment conversation, I saw a lot of tweets over the weekend about people saying, like, where are we going to go next? Like, is it TikTok? Is it Instagram? I don't know if it's either of those platforms, but at least on my feed, there's a lot of people, looking for alternatives. Although my own opinion is that people aren't really going to go anywhere. They're just going to continue to complain and accept defeat. What do you think, Ben?
I think it's kind of Twitter or nothing. I mean, the problem is that, why would you go to a platform where other people are not? So people are still on Twitter, it's still where the conversation is. So I guess we just have to complain and bear it.
Wendy, we need to get you in on this. I know you have your fans on TikTok.
I mean, TikTok has a lot more users than I want to say, or active users, than I think any other social media platform. People have been all over TikTok for a very long time. I've actually advised multiple companies that I've consulted with, start a TikTok. The startup cost to market there is very affordable, especially when everybody was going viral, getting lots of views. Most of the companies didn't do that, and now they want to merge over to TikTok. And it's not necessarily that it's too late, but the algorithm, there's a lot more users there. Platform's a lot harder to go viral on. So I think that, there's different audiences on different of the social media platforms, and we'll just kind of have to wait it out and see what happens. I mean, at this point, there's still rumors that TikTok could potentially get banned due to the Restrict Act. So we'll kind of have to wait and see how that plays out. I don't know. I haven't seen the rate limit thing been inactive, but it wasn't really clear that, like, if you're scrolling your feed, does that count as tweets being read? Or if you're looking at your mentions, does that count as tweets being read? It wasn't really communicated well. So I'm still kind of confused if it's even happening. And I kind of feel like because of all the backlash, Elon's going to be like, oh, we're not going to do this.
I hope so. Ben, you have our next story.
Yeah, so my story is about two little announcements coming out of Hong Kong and South Korea, and they're both positive for Web3 development in those places. So the first from Hong Kong is news about a task force set up by Financial Secretary Paul Chan, comprising 15 officials to try and find better ways to encourage blockchain technology on that in that territory. And the second one, probably more important, from South Korea, the National Assembly there has passed the Virtual Asset User Protection Act, which I guess is in the wake of Do Kwon and Terra Luna. Big scandal there. It's 19 proposals from lawmakers defining digital assets and setting up penalties for unfair transactions. And I think the bigger kind of context here, particularly relevant to the United States, is that, it's a global market. The United States faces global competition from all kinds of places wanting to be crypto hubs. And of course, we have regulatory uncertainty here and no prospect really of comprehensive crypto regulation, at least in the short term. So I think we're going to continue to see the US under pressure from these different locales setting up different regimes that are more favorable than what we have here. So watch out the US.
Ben, I think your take on this is exactly right. To see different countries really embrace crypto, make clear regulation. It's just like a stark difference from what's happening here in the US. Last week, we talked about the spot Bitcoin ETF filing. The SEC came out at the end of last week and said, those filings are inadequate. The asset managers who filed need to go back to the drawing board when it comes to certain elements of it. We have the lawsuits against Binance and Coinbase. And it just feels like we're going around in circles while jurisdictions like Hong Kong, like South Korea, are making it easier for crypto companies to understand what's happening there so that they can comply. Wendy, I see you laughing over there because it is just such a laughable matter. So we got to get you in on this.
I mean, like, I tell my audience this all the time. Every single time a public servant makes a decision, every single time they breathe, every single time they move, we pay for that. Our taxpayer dollars fund their salaries. And the fact that we are not getting the representation that we deserve, that we want, and we're wasting all of this time in this back and forth fighting over petty, ridiculous things is kind of embarrassing. I mean, I do believe that we're in a recession. I don't think that inflation is going to go down. I feel like America has a lot of problems. Instead of looking at different ways to raise revenue, to get people to pay taxes on their crypto assets, these companies were pushing all of this innovation out. We've seen this in the tech industry. I mean, if you look at California, we've pretty much pushed quite a few companies out of California, and we're kind of in dire straits right now. If you just take a beautiful walk downtown LA, the amount of homeless folks that you'll see. So I don't know. To me, it's just very upsetting. And if you're in crypto, if you're in NFTs, I think it would be a good idea to consider looking at other places outside of the country to relocate to, so you can actually run a business, because we really don't know what's going to happen. And unfortunately, I don't think we'll see any type of clarity until after this upcoming election. And I am voting for whoever's pro-crypto. I don't care about the social issues.
Can I just make a quick plug? Last week, CoinDesk published its Crypto Hubs package, which was a list of 15 jurisdictions from around the world that we think are doing a good job of attracting crypto talent, crypto capital. And it was clear evidence that there's a lot more movement in those places than there is here. And it is a global market, and companies are really seriously looking at relocating, and the US cannot sit on its laurels anymore.
Ben, any surprising jurisdictions from the CoinDesk Crypto Hub list?
There were a couple. Vancouver was on the list, which kind of surprised me. And actually, New York was on the list, but I think for incumbent reasons, not for anything that's particularly done. But those would be the biggest surprises.
Yeah, I'm actually shocked that, because isn't a lot of crypto stuff banned out in Canada, Jen? Or not necessarily banned, but isn't it kind of murky, or they're starting to really crack down and not give you guys any types of guidelines similar to the US? Or
Canada is similar to the US. There are new regulatory guidelines that have pushed some crypto exchanges outside of Canada. Binance is one of those exchanges that decided to leave. But then there are other exchanges like Coinbase who remain very bullish on Canada. And a few unicorns have come out of Vancouver. So Vancouver is maybe a burgeoning crypto hub. But I would say that, when you look at what's happening in some of these areas outside of Canada, like Hong Kong, like South Korea, like Europe with their MiCA regulation, I'd say they're probably still ahead of us here in Canada. But I still need to celebrate all Canadian news. That's just my shtick on the show, especially after Canada Day.
It's good. I disagree slightly with Wendy. I think some regulation is better than no regulation, or what we have in the US, which is just a complete, what the hell's going on type of situation. So,
the only thing I do want to say is that I am very big on compromise. Me personally, I can operate in a true decentralized economy. I don't need anybody coming in to rescue me or to save me. I have a very just due to some of my life experiences, I haven't had the law ever really do anything positive for me or people that I've known. And I've actually seen terrible things happen. But I just would like some sort of compromise. I think compromise is important, and I don't feel that we're getting that in the US. It's just more so they're just shutting everything down. They're not willing to listen to the people that not only put them into power, but that are also paying their salary. And I think that's a problem that's not just that's not just selected towards crypto, but it's on all different types of sectors. I feel like the United States government has just gotten too big. The egos are too high. We need to establish term limits and all those other things. And I would love to see a happy medium. But I just feel like we're not necessarily going to get it. But
totally agree with that.
All right, we're going to leave it there. We're going to take a short break. And when we come back, an NFT project is launching a film. Find out which project that is after this break. and welcome back to The Hash. Atrium, a network of artists led by former animators from Pixar, Netflix, and Marvel, is bringing one of the first animated films funded by a DAO to life. The Rise of Blues, a Nouns movie, has a budget of $2.7 million and aims to turn the NFT collection into entertainment. Joining us now to discuss is Atrium founder and CEO Supriyo Roy. Welcome to the show, Supriyo.
Hey guys, can you hear me?
We can definitely hear you. This sounds like an exciting time. Tell us about how DAO is involved in decision making for this, because I think about the movie making business and there are a lot of different parts, and adding a DAO to it sounds like it's going to make it even more complicated.
I think one of the really interesting things about the DAO, in particular Nouns DAO here, has been that they give you a ton of autonomy. So the creative directors are involved day to day. So they would share all of their core sort of major decisions back to the DAO, back publicly, even into the forum discourse and things like that, and including our Discord even. And we have windows of feedback. So you come in and you can share your feedback, criticism, critique, things like that. And within that time window, if you don't give it, you hold your peace. So that's how one of the ways we have been able to make progress and stick to our milestones and adhere to a certain quality. So it's not really too many cooks in the kitchen in that sense.
You know, when we think about traditional films, they usually have these massive advertising budget. They have actors who we know. They have characters who we know. How are you advertising the film, or how do you plan to advertise the film to people outside of the community?
Yeah, absolutely. I think one of the really unique things going here is something which we call internally as a proof of audience, because you have the DAO, because you have multiple sub DAOs and really enthusiastic community who's like getting behind it. You are not starting from scratch. So there is an organic word of mouth. People appreciate it. People being part of that production workflow makes the movie seen from the day one. So it's not being really created under wraps for 2 years and then coming out and, like you risk it, whether it's a hit or a flop. One of the things which we are looking at doing is, as we continue to go further down into the story, we would be exploring bringing more partners from traditional distributions and things like that to really go beyond our current core audience. And that's one of the things I think which is the beauty about the movie itself is it's trying to do is tell a really, really good story based on the public domain. It's not about NFTs. It's not about how it came to life. It's about the story itself. And if the story is good, people will care. So that's essentially the working thesis there.
So I have a question for you. My question would be, so because it's a film that's funded by a DAO and it's utilizing the Nouns NFT collection, so are community members NFTs participating in the movie? And if so, are they collecting like IP royalties, or how does that work?
That's a great question. So one of the things here is Nouns is public domain IP, right? So technically you do not need permissions to put a certain IP piece from the Nouns ecosystem into it. One of the things which we have been doing is intentionally sort of figuring out pathways on the story where we could include community members to submit for casting calls and submit for their own sort of unique cultural references, which we can include into the story. And, they wouldn't be blatant product placements. They need to fit organically in places where it would make sense. And then the things which we intend on doing is, because it's funded by the DAO, principally, Atrium and Nouns together would share any upside which comes from the movie in the future. Like, we are really early, as in the pilot has just been 4 minutes into a 80 minutes feature. So we intend that once the movie is complete and as and when it starts to accrue revenue, it essentially would be shared back with the DAO directly.
I love that.
It sounds like a great project. I love this. So if I buy one of these Nouns NFT today, can I still have some right to kind of have, a say over the direction of the movie, or is that still closed now?
Yeah, Yeah, essentially, right? So I think one of the things there is nouns, the way the core DAO itself works is nouns is one at a day forever. Every single day you have one NFT going on an auction, and whichever the auction settling amount is, that goes back directly into the treasury. And your noun is one vote on how you spend the treasury, right? So the movie work stream is just one of the projects nouns has actively voted on and, continues to sponsor. And if you're particularly interested in influencing, how the story is being told, yes, absolutely. If you own a noun or you own a affiliated sort of sub-DAO community, you can come in and join and, actively participate in how we are working through concept stages and pre-production, things like that.
If the movie makes money, are the DAO members going to share in that revenue?
The DAO will, yes. So I think one of the things which we put out in Proposal 245, that was the kickoff of the movie, was that when the movie creates revenue for itself, we would do a split, whether it's a 50-50 split or a 60-40 split, we'll see. But principally, the DAO here is acting as a production sort of financier. And they, if the film makes money, then that money gets back to the DAO. So the DAO has ability to recoup the cost. And then another thing which is really, really interesting is the movie crew is really agile and small, considered to a lot of larger animation productions. So a lot of artists have opportunity to share in that upside as well.
All right, Supriyo, we're going to have to leave it there. We look forward to seeing the full-length film. So congratulations on that and good luck on the rest.
Thanks a lot. Thanks for having me.
That was Atrium founder and CEO Supriyo Roy. All right, we are going to stick on the NFT beat. Our last story is a follow-up on the Azuki NFT saga that unfolded last week. A group of Azuki NFT holders is voting on the return of 20,000 Ether a week after the Azuki project faced backlash over the Elementals NFT mint. Reasons given for the proposed refund ranged from disappointment with the collection to the teams blatantly scamming the purchasers of the NFTs. The vote proposes to allocate funds retrieved back to a DAO to promote the growth of the community. Ben, I'm going to kick this one off to you. What do you make of this DAO vote to refund some of those people who feel like they were scammed?
Well, I was off last week, so I missed some of the drama here, but it does seem like a scam to me, and thank God they're returning the money.
We don't know if they're returning the money yet, Ben. The vote has been proposed, but I don't think we've come to any kind of resolution. But Wendy, you had a big sigh there. So what do you think?
I don't think it's a scam. I think what it is that there's a lot of grifting in NFTs. People build their NFTs around the ideology of community, and that's fantastic. However, releasing multiple generative 10,000 AI collections or whatever these guys or people are doing is not how you build a community. But it's kind of been like the culture in NFTs for a long time. I personally think that NFTs were, created for people to have ownership, for people to own their in-game items, for musicians to own their music, for people to own different parts that they participated in when it comes to films, et cetera, for writers. So again, these guys, they have a lot of money that they needed to pay for their community event that they had. We all know that parties are expensive. I don't think it's a scam. I think it's a disappointment. And I think that people should, kind of consider that NFTs are not, that it's still an investment. At the end of the day, you're putting your money into something. And if you're expecting a return, I'm not exactly sure what to tell you. So I don't know. I think it's pretty sad that they've kind of abused their community that way. But in the same respect, we're in a bear market, and I'm not really seeing a lot of innovation from the current NFT projects out there right now.
Yeah, just to give our audience a little bit of background, just in case you missed what happened last week, the Elementals NFT project kind of proposed the project was going to be something that people who bought in felt it wasn't. I think $38 million of Ether was spent on these NFTs. And then when the artwork was revealed, it was very similar, almost like a copy and paste of the original Azuki collection. I know we have a graphic of a side-by-side, there we go, of the original artwork, the artwork in the new NFT collection. this drove the floor price down. People were really upset, saying this is the exact same. It's almost like brand value, right? When you replicate something, the brand value of that original thing goes down. And now there's a DAO of NFT holders who want their money back. I think it's notable that the DAO has 72 members as of Monday and only 36 votes on the proposal, and 40% of those votes are coming from a single holder. So this story also kind of amplifies that DAO narrative of, like, who is voting in a DAO? How are we ensuring that it's actually the voice of many people and not just a few? Wendy?
This is the thing that drives me absolutely crazy about DAOs, and this is what I've been screaming for a long time. I feel like DAOs are just a reproduction of the current system that we have in America. You have a couple people in power, even in other countries too, and they make all of the choices for you. If were able to get early access into a project, or you have a lot of money, you get the say as to what can and can't happen. To me, that's not community. To me, that's not even really what a DAO is supposed to be. But again, you guys, we're still in beta. I think that things are still early, and I think we do have the opportunity to change the way things are done and essentially really level the playing field out as to how DAOs wanted it to be. But right now, nope.
All right. Yeah.
I agree. I think there's too many projects calling themselves DAOs and not really behaving like DAOs, or at least what we'd expect to be DAOs.
We're going to leave it there. We'll see you everyone on Wednesday. Good morning and welcome to First Mover, your first global look at today's action in Bitcoin, blockchain, and digital assets. I'm Jen Sanesi here with my co-host Lawrence Lewitton, content director at The Tie. Let's take a look at what's going on in the markets this Monday morning, starting with Bitcoin. The CoinDesk Bitcoin price XCX index is currently at 30,642, holding steady above that 30K line over the long weekend. We all had a nice, relaxed weekend with that price just kind of remaining the same. Let's take a look and see if Ether is following suit. The CoinDesk Ether price ETX index is up about 2.3%, 1,965, giving us a little pump over the weekend. And let's see what's happening with DeFi assets. The DFX CoinDesk's DeFi index is at 119, just like Bitcoin, not doing much over the weekend.
The State of Crypto is presented by Tron, connecting the world to the power of cryptocurrency.
All right, the SEC reportedly informed NASDAQ and CBOE Global Markets that ETF applications, including BlackRock's, are inadequate. This comes as the agency continues its battle with centralized crypto exchanges in the United States. Joining us now to discuss is CoinDesk Global Policy and Regulation Managing Editor Nick Day, who is also the editor of CoinDesk's State of Crypto newsletter. Good morning, Nick.
Good morning.
How's your weekend?
It was very good. How was yours?
Also very good, Nick. Let's get into the news this morning. We have CBOE's BZX exchange that named Coinbase as the market for its surveillance sharing agreement in its spot Bitcoin ETF refiling for several would-be Bitcoin ETF issuers. Explain to us what happened. What does this all mean?
Yeah, so the SEC has long said that one of its concerns about approving a Bitcoin ETF, a spot Bitcoin ETF specifically, is the lack of surveillance sharing agreements with regulated markets of significant size. We've seen that over and over again in various ETF application rejections. So last week, the SEC reportedly told Cboe and Nasdaq, which respectively are filing or acting as sponsors for ETFs issued by Fidelity, BlackRock, a host of other companies, that it wanted to know who the market was. And Cboe later filed saying, okay, well, our partner is going to be Coinbase for all of these ETFs. And, obviously the SEC has sued Coinbase, but importantly, it's not over Bitcoin. So the question now is, will the SEC agree that Coinbase maintains a significantly sized market for Bitcoin that will, allow it to spot any kind of potential market manipulation or fraud or any kind of, malicious activity that might impact the Bitcoin ETF's prices?
Does this kind of cross a little bit of lines here, because CBOE obviously regulated by the CFTC, the CFTC approved Bitcoin futures to be traded on the CBOE based on the formulas that they use. Is this kind of a little bit of the SEC stepping on some toes here? It sounds like, I don't know, maybe I'm wrong, but also, do things get harder for these ETFs by having Coinbase involved?
So as far as the first question, I don't think so. The SEC has always been the ETF regulator. The question is always what is the underlying spot market look like? So even with Bitcoin futures, that one, the Bitcoin futures were more directly and explicitly regulated by the CFTC, which the SEC said when it approved the Bitcoin futures ETFs. Right now, there's no explicitly named federal spot market regulator for spot Bitcoin markets, and that's been kind of a point of contention. And that gets into a whole broader political conversation that we've talked about before on the show. As far as whether Coinbase specifically is going to make things easier or harder for Cboe, again, the SEC has sued Coinbase on, for allegedly listing unregistered securities, but none of those are Bitcoin. The SEC has, come out and said that Bitcoin is not a security. We've seen that in courts. So, it'd be very hard to argue for anyone that Bitcoin markets are securities markets. I think the bigger question comes down to, what exactly is a regulated market of significant size, and does Coinbase fulfill that parameter? And I don't know if we have enough guidance one way or another to be able to say for sure at this point.
Nick, what are the next steps you expect to see in this process?
So the first thing right now is we've seen the sponsor, that is Cboe and Nasdaq, file the 19B4 forms. That's kind of them saying like, okay, here's what we want to do. The SEC has yet to formally acknowledge that it's reviewing these applications. So we're waiting for them to post it first on their website and then on the Federal Register, which is the national logbook. Once it's out on the register, that kicks off the first 45-day review period. And my guess is they're going to extend that. They've always extended all the Bitcoin ETF application review periods. And given this is going to be a first, if one of these is approved, it'll be a first time for it to be approved. My guess is we're going to go see whoever do it go through the full, 240 days. But right now, the first thing we're watching for is when the SEC publishes the documents on their website and kicks off that clock.
Nick, thanks very much for joining us this morning. We'll see you tomorrow. That was CoinDesk Global Policy and Regulation Managing Editor Nick Day. Don't forget to sign up for the State of Crypto newsletter on CoinDesk.com. Joining us now for more reaction is the founder and CEO of Architect and former president of FTX US, Brett Harrison. Brett, welcome to the show.
Hi, thanks for having me.
All right, first we want to get your thoughts on what we've just been talking about, the SEC reportedly saying recent filings to launch a spot Bitcoin ETF are inadequate. What do you think when you hear those comments?
So it's natural that with these applications mentioning that they finally have a surveillance sharing agreement with a regulated market of significant size and underlying asset, in this case Bitcoin, that the SEC is going to want to know who is that surveillance sharing agreement with. And of course, these applications got refiled with Coinbase mentioned as the underlying. To an earlier point with Cboe, Cboe has multiple different exchanges. They have, of course, their equities exchanges, which they received when they merged and bought, BATS, BATS-Y, EDGX, EDGA, which lists normal securities like Apple and, the S&P 500 ETF SPY. And so the SEC has full jurisdiction over those exchanges as national Form 1 securities exchanges. They also have their futures exchanges for Bitcoin, which they received when they acquired ErisX, the DCM regulated by the CFTC. So CBOE is sort of, as an organization, they have inroads into the SEC and the CFTC. Of course, the principal issue here is, given that there's been a futures ETF approved, for example, the Bitcoin future as the underlying coming from the CME, and the SEC determined that there was enough surveillance sharing agreement in place with CME to regulate Bitcoin futures, but ultimately the Bitcoin futures are settled by the underlying spot markets, which of course reference Coinbase. The question is, if now the ETF is directly referencing the Coinbase Bitcoin market and has a surveillance sharing agreement directly with Coinbase, will that be adequate for the SEC to approve these ETFs? And of course, many people are saying it should be. It's sort of arbitrary for the futures, but not the spot markets to be approved in this case.
But nonetheless, I mean, do you think that knowing the SEC the way it is, do you think that it stands a chance? I think that's a big question that everyone has here.
I think it does. I think the question is whether ultimately, if the SEC wants to, put up the fight and say, I'm sorry, but BTC on Coinbase is not a significant enough share of the market to prevent manipulation, especially given what a large percentage of the Bitcoin price is driven by non-US markets, then, they can of course take that position, and then it's up to the various ETF issuers to either, to withdraw, to follow up again later, to bring lawsuits, which of course, several ETF issuers have already. And so it's sort of a wait and see, and the ETF issuers are completely at the mercy of the regulator here.
So how would that compare, for instance, with gold or oil, which have significant overseas presence? Are the prices move significantly with those commodities outside the United States?
I think that's an excellent point. So, in the U.S., we have two markets regulators, like the SEC, which regulates securities, and we have the CFTC, which regulates commodity futures. But we do not have a clear markets regulator for spot commodities. Now, the CFTC does have, anti-manipulation, anti-fraud authority over spot commodity markets in the U.S., but they don't have markets regulatory authority over spot commodity markets. For example, the spot gold markets, or even things like, spot currencies. Yet there are, for example, ETFs like the GLD Gold Trust, and there are, ETFs on spot currencies as well, which of course are affected largely by, trading in international markets, most of which is unregulated activity or certainly not regulated under U.S. regulatory authority. And so that does bring up this interesting question of, is it arbitrary that the spot Bitcoin ETF cannot be approved when these other spot commodity ETFs, regardless of how they've been structured as a trust or otherwise, have been approved in the past?
Do you think that the SEC is in general acting a little too arbitrary here, or do you think that they're being cautious? Do you think that they're being properly cautious with not just this situation with the ETFs, but also with their lawsuits involving the likes of Binance and Coinbase?
I think the SEC is taking the position that, their primary goal, as they should be as a regulator, is to protect investors. It's to make sure that especially retail investors are protected. Of course, the question here is, given the still unbelievable international and domestic interest in getting exposure to crypto as an alternative asset, especially in large portfolios of institutions, what is the safest way to allow investors to get that exposure? Well, if you're concerned about, the existence of exchanges and how they are properly surveilling their own assets and custody, given everything we've seen in recent weeks, turmoil of other companies that have obviously gotten in trouble about custody. An ETF feels like one of the safest, most secure, and most highly regulated vehicles to give retail investors and institutional investors access to the spot market. So certainly I would think that if the goal is to have investor protection, given how much interest there is in getting exposure, that ETFs seem like the right vehicle to achieve that purpose and bring it under SEC jurisdiction, and therefore it would be in their best interest and investors' in best interest to approve it.
It feels like we have two narratives at play here. The ETF narrative seems like a very positive one. And then we have the rest of the industry, which is really under the magnifying glass from the SEC. Do you think that this legal action poses an existential threat to crypto in the US?
I think that perhaps there's a very US-centric view of the crypto markets. And from all of the different potential clients of our company that we've been talking to, many of which are not in the US, the sentiment outside the US is still quite positive. I mean, we have jurisdictions around the world that are actually coming forth with significant either new proposals for regulatory frameworks or rules that are going to be able to allow businesses to exist and thrive in those particular regimes. When we think about Hong Kong, Japan proposing various rules to help ease tax burdens on people who are launching tokens. Obviously, in the UK, lots of recent news, EU with MiCA. And so I think that while, of course, it's troubling in the US to see a lot of the recent regulatory action taken against players in the market like Coinbase that are certainly walking the direct path to trying to be a regulated business in whatever way possible. Outside the US, I think businesses is thriving and in general, the sentiment is positive.
Would you consider moving your operations outside of the US?
It's important for us to maintain operations in the U.S. We think that whatever temporary issues there are with markets and exchanges and crypto companies in the U.S., we think over the long term, if you look at everything from BlackRock's interest in a Bitcoin ETF to individual banks talking about working on private blockchains, testing out different kinds of tokenized assets, different tokenized versions of real-world assets. I think we're in general quite positive over the long-term sentiment for crypto in the U.S. However, we inherently want to have a global operation, which is why we're continuing to expand to places outside the U.S. We're serving customers outside the U.S. as a software company, but our operations we are going to continue to run in the U.S. and we're not moving.
What do you think about the future for native crypto exchanges? I know we're sticking in the US here now that CBOE, CME, and EDX markets are gaining more traction.
I think you're going to see probably three kinds of exchanges that are going to continue to coexist and pick up steam over the next, call it 2 to 5 years. You're going to have your existing models, for example, Coinbase, where you have this vertical clearing, settlement, and exchange matching all in one. And there's a question of, can that exist only for spot commodities like Bitcoin that are sort of outside of the regulatory authority that currently exists by the SEC and CFTC? Or will those be able to include other kinds of tokens as well, or even sort of security-like tokens? Digital asset securities. That's number one. Number two, you will see exchanges that will take a different approach, which is to model themselves off of traditional securities market structure. So, for example, EDX is a good example of where they've very carefully separated the clearing side, the custody side, and the exchange matching side. Of course, that also flies in the face of a lot of what crypto is supposed to represent, which is a compression of these roles into one to bring down costs and produce operational efficiency, having real-time instantaneous settlement. That's sort of the purpose of a blockchain to begin with. And so people are going to want to prefer one versus the other. And finally, you have DeFi, and the growth of DeFi will continue. It's a question of to what extent that can exist in a regulated fashion in the U.S., or whether U.S. people are going to be cut off to access. But I see those three exchange types continuing to exist and grow and thrive within the U.S.
So speaking of exchanges, obviously used to run FTX US, and there's talk that FTX might restart. What do you think the odds are of it getting off the ground? And kind of where are the valuation? What's the value added that a restarted FTX would bring to the market? Can the name brand itself is obviously an issue, right? It's really hard to convince people to say, you know what? Yeah, you put money in FTX before. This didn't work out for you, but here's FTX too. Why not put money in that? Or would they have to rebrand? What's the technological underpinnings that you think would be value added here?
So there's a lot to unpack about the potential possibility of a restart. And without, particular insight into what, the existing plan would be or who the potential bidders are, it's hard to say what the odds are of it succeeding. But to talk about some of the, the issues at stake here. So first, of course, a rebrand is obviously going to be necessary. I think most people agree on that. I think technologically, there's a question of, to what extent does the existing infrastructure need a complete revamp in light of now everything that we know has happened with the people running the exchange? Or can it actually be taken as is, patched a bit by, a large team of experts and then just kind of restarted wholesale? And, I think the prospects of restarting have to do with the fact that the reason why, in my opinion, FTX grew so quickly in the beginning was because it brought together some truly, novel combinations of concepts to derivatives markets. It's brought real-time clearing, real-time margin, 24/7 direct-to-customer derivatives operations. And that was a very powerful concept, and it was the reason why many institutions around the world were trading on FTX, preferring that over other kinds of markets. It's why it was such a significant moment when FTX US, really with Ledger X, which has now been sold to Miami International Holdings, it was such a significant moment that it was trying to bring that direct to retail, direct margin model to CFTC regulated derivative markets. I think if that can be restarted, I think that's a very important, market structure concept that should have a chance to exist. And finally, I think that people would like to see, of course, the customers repaid, myself included as one of them. And I think the possibility of restarting the exchange when it was a significant, revenue earner as a company could be very helpful in bringing, more assets back to the exchange to be able to distribute it back to customers to make them whole.
Have you spoken with Sam Bankman-Fried recently, or what's your relationship like with him now?
I haven't spoken to him, in close to a year. I mean, since, obviously I talked very publicly about kind of the falling out we had while I was still at the company. And at that point, Sam was barely speaking to me from within the company. And, since I formally resigned, we haven't spoken at all.
I guess on that note, what lessons have you learned since working at FTX US that you think are kind of relevant for the rest of the industry to hear?
I think, working at FTX US and having, an unbelievable team under me, I think that the lessons are that this industry is going to thrive. It's significant. There are many players who do believe in the long-term viability of cryptocurrencies to revolutionize financial market structure. And there are many passionate individuals who are going to be helped to make that happen with really incredible resumes, prior to joining the crypto industry. And I think it's important to not see the short term of even what we're seeing now with the regulated, regulatory environment in the US, to think long term about how do we build a lasting, sustainable industry that enables both institutions and retail to thrive in a way that, of course, protects investors, but also enables the new promise of this technology. I think that it's taught me and the people that I work with that this is an industry that is worth sticking with and worth building in.
I guess that's a great segue to your new platform, crypto infrastructure trading startup, Architect. You're using AI, you're using the lessons you used from FTX US to bring this to life. Tell us a little bit about how you are incorporating AI in Web3.
So our company Architect, it's a software provider that enables seamless integration of trading across a variety of different markets, from centralized crypto exchanges to decentralized protocols to OTC liquidity providers to regulated derivatives exchanges like CME and CBOE. And part of what we want to do is lower the bar for institutions and individuals to be able to enter the kind of professional trading space, especially when it comes to algorithmic trading. And as one feature of our product, we absolutely have been exploring uses of AI, especially recent advances in LLMs, to lower that barrier to entry. And so, for example, one of the things that we created for our first product is a way for people to enter natural language instructions for a potential trading algorithm that they want to execute, and have Architect creates code using OpenAI that enables them to kind of jumpstart and get a working piece of code that runs a trading algorithm using Architect's internal APIs. And so we're excited to look into a number of different ways that we can help seamlessly trade across all these different exchanges. But certainly AI is a way to help reduce a lot of the initial start to get over the boilerplate of writing code to be able to trade across these different venues.
Some have said that AI could be the catalyst in getting us from Web 2 to Web 3. Do you agree with that? Or do you think that it's a tool, like you're explaining, that may just help us develop some of these things faster?
I see it more of a tool. I think even within our company, we are using ChatGPT every day to kind of assist our own development efforts. It's an incredible tool. It's kind of like having, an intern and a mentor at once with you all the time as your companion, helping you code. I think it's just one tool in the toolkit. I think it's important that people not get too distracted in thinking that AI is some kind of panacea for all potential issues in all technological areas.
Brett, thank you very much for joining us this morning.
Thank you so much.
That was Architect, CEO, and founder Brett Harrison. We're going to take a short break, and when we come back, we'll be talking about what's going on in the crypto markets. Stick with us.
Bitcoin continues to show upside potential as issuers work to refile, or actually even scramble to refile, their Bitcoin ETF applications. Joining us now to discuss is Coinbase Institutional Head of Research, David Duong. Welcome back, David.
Thanks for having me on.
I'm glad to see you again. So I kind of want to get your thoughts first here. Wall Street Journal reporting that the SEC's current that the SEC is saying that the current Bitcoin ETF filings were inadequate. What are you hearing from institutional investors right now?
So, I mean, this happened. I was actually just on a market roadshow in Europe and talking about this. And I think that the reaction has so far been mixed. I think a lot of people recognize that it's important to have these ETF filings, particularly since, we already have a lot of these offshore or non-US, I should say, ETFs. But the issue is they oftentimes, depending on the jurisdiction, are perhaps less liquid. They may be more expensive. They're definitely not as accessible as what I think a potential spot ETF in the US could actually represent. So I think there is a lot of people who feel encouraged by this, and the names coming out here obviously are very strong. But I don't think so far, and this is kind of reflected in the price, that just because we get this kind of one stumbling block kind of from the SEC that things are over. This was kind of par for the course, that this was not going to be an easy path.
You talk about this, the difference in institutional interest between overseas, and by overseas you mean over Lake Ontario, because we do have an ETF right now in Ontario, in Canada, this spot ETF, and yet it doesn't seem to have the sort of same legs that one would have expected. Is it because it's in Canada, or is there any? I mean, have we maxed out on the possibility, or just about? Are we putting too much hope in a U.S. ETF?
Well, I don't think so, because I think, the way large asset managers in the US kind of work, oftentimes, they use a bunch of these ETFs to varying degrees in order to kind of specialize. They have specific investment strategies that they're trying to impose. Some are very focused on, if we just kind of broaden out from crypto markets, like, bond markets, credits, equities, et cetera. But, I would say that we need kind of just the anchor here. And I'm not saying that some of the existing ETFs just don't provide that, but I think that you need to see some of the complexities that are often incumbent inside of US-based ETFs that allow these money managers to actually combine and kind of use those kind of products to implement these strategies.
Do you think the timing is surprising given the SEC's lawsuits against Binance and Coinbase?
The timing of BlackRock coming out with a filing. I mean, not just BlackRock, of course, like multiple people. It was just on the screen, but I think it was certainly a surprise that this came out at the time it has. I think it sends a very strong signal, which is how the market received it. That even with these kind of cases pending from the SEC, that institutional adoption actually looks cleaner. And I will say that, I spoke to a friend of mine, TradFi person, who just isn't involved in crypto at all. And basically, he was saying that, this was the time he thinks to actually be invested in crypto. And I kind of asked, like, well, why do you think that? Like, well, what is it about this moment, given that you're hearing about, SEC against Binance, SEC against the Coinbase? And he's like, well, this is just how sausage gets made. Like, at the end of all things, like, I do think that this is regulatory clarity in the forming. Like, this is how it's going to get done. So he thinks that now is the opportunity to actually get in here and perhaps try to start looking for some opportunities in the crypto space.
Given that, what's your outlook on Bitcoin for the second part of the year?
So I think I said it last time on the show. I am constructive on Bitcoin into the second half of the year. I still haven't given up on the idea that we're in a tough kind of upcoming period. I think a lot of people, if you look at stock prices, you look at other risk assets, it seems pretty optimistic. I think a lot of people aren't as concerned about a hard landing scenario as they were previously. I'm not so sure, frankly. I still do think that the probability of a recession, it's probably two-tiered about what's going on in the US as well as Europe, but I do think that something could still materialize, and I'm not fully convinced that we've solved all the problems here that would negate that. For example, the credit crunch environment that we're currently in, for example. I do believe that, the Fed would be making a mistake, for example, if they started to hike rates in July with another 25 bips. But that being said, I think by the time we get into the fourth quarter of this year, probably the outlook's going to be a lot better. I think very likely disinflation will be in full force. The Fed will probably be cutting rates at that point. We'll be thinking about the Bitcoin halving in 2024. And a lot of the sell pressure from some of the technical aspects of the supply-demand situation will have been resolved.
You couched it in negative terms, but it seems very bullish because right now it looks like the Fed is going to most likely raise rates. I mean, the market has priced it that it's going to raise rates 25 basis points. And Powell has repeatedly, not just Powell, but everyone else repeatedly said, we're going to keep going. There's no stopping us. We're going to keep going until we see the number we want to see on core inflation, that we want to see on the producer's price index and everything else. We're not happy with the way inflation is going, and rates are going to keep going up. It seems as if the equity markets and the bond markets and now the crypto markets, they're not taking that seriously. How come that's not a big mistake?
So there are a few things. Number one, I think if you look at what happened last week, so the ECB had its annual meeting, very much akin to Jackson Hole in the US, for example. Powell was there. We saw Andrew Bailey, Ueda, Lagarde, and they came out very hawkish, with a mild exception of Ueda, who is still on pause with the idea of switching from yield curve control. But I think it was interesting to see two things. Number one, the transmission of policy which was kind of a missed point by a lot of people. Like there's definitely a two-tier system where it's actually happening a lot faster in the US than it is in Europe. And number two, I think immediately after those meetings, you kind of saw a kind of rejection of what happened with the ECB, where they hiked rates by 50 basis points. At the time, people said, okay, that's necessary to kind of contain inflation. But subsequently, it showed that a lot of policymakers recognize that there's a concern about how negative this could actually be for the economy. So I think it's getting the ECB to think twice. And I think that's probably going to get the Fed to think twice as well.
David, we're going to have to leave it there. Thanks so much for joining us this morning.
Absolutely. Thank you very much.
That was Coinbase Institutional Head of Research, David Duong. Coming up, Compound founder Robert Leshner joins us to discuss his plans to create a bond fund with Ethereum for record keeping. Stick around to find out how that works after this break. A new company plans to invest in short-term U.S. government bonds using the Ethereum blockchain as a secondary record-keeping tool. Joining us now to discuss is Superstate CEO Robert Leshner. Welcome to the show, Robert.
Excited to be here.
We are excited to have you here. Tell us about how this is going to work.
Great question. So the way this is going to work is that we've created a new company, Superstate, and Superstate is an investment manager. And what we're going to be creating are mutual funds, which are a very straightforward and, simple investment structure. And those mutual funds are going to be purchasing government bonds. And the shares of these mutual funds are going to be able to be recorded on Ethereum as well as in a traditional ledger. And the advantage of this is that crypto native investors, whether they're hedge funds, venture capital firms, professionals, will be able to store a record of their ownership alongside their crypto investments in whatever custodian they're already using for crypto investments or record keeping systems they're already using, whether it's self-custody or another system. And so if you're a crypto native investor, in addition to having crypto native assets like Ether, Bitcoin, et cetera, you're going to be able to have traditional assets in the same technology stack. And we believe that this creates advantages because they're going to be able to access investments that they don't already hold in their portfolio. And over time, the goal is that crypto native investors are going to be using real world assets, such as a Superstate fund, in replacement for certain other crypto issued assets like stablecoins. And that over time, these funds can really be a settlement, trading, and base layer for crypto economies.
This sounds like a lot of regulations that it touches on a lot of regulations, and I'm wondering how prepared are you to deal with it? In other words, from what it sounds like, you have the transactions themselves, they're occurring on blockchain, but then recorded in the centralized database as well as on the blockchain, correct? And then you also have questions about custodianship, et cetera. So how are each of these aspects addressed? We're seeing the SEC has a particular interest, or they're quite enthusiastic, shall we say, about enforcing a lot of this. So how are you addressing so many of these concerns here?
That's a great question. So, the first thing to understand is that these are registered and regulated products. So on Monday of last week, we filed a preliminary prospectus with the SEC to create the Superstate Short-Term Government Bond Fund. And, this is the structure for this product. Obviously, there's going to be a discussion process with regulators as they get to understand the product before it can go live. So that's the first piece. The second piece is that, this is an intermediate step along the way to, a full decentralization of, custody, record keeping, and settlement. When we're creating this fund, we're actually not using the blockchain as the primary source of records. A traditional SEC registered transfer agent is going to be the source of truth. And the blockchain is a supplement to that. So far there haven't been any products that they've approved that fully rely on on-chain record keeping and settlement. And I think it's going to be a number of years potentially before, Superstate or any other, fund manager is able to use the blockchain in a regulated product as the primary source of truth. There's still an SEC registered transfer agent at the heart of this, and that creates inefficiencies, right? You basically have a TradFi record keeping process and the blockchain record keeping process. The real efficiencies come in the future when you have just an on-chain record keeping process. And I think, at that future state for the industry, you're going to see a lot of operational efficiencies. You're going to see, these assets when they're issued on chain, moving fast, quick, and accurately. And we'll get there eventually, but it's right now a two-step process.
I mean, it will get there eventually. It's the Messiah will come too eventually. This is the question of how long? What's your timeline here in getting this implemented? And are you concerned at all that, as so many people have been, that in working with the SEC, you open yourself up to being punished by the SEC, if you will?
Yeah, it's a great question. So we would like ideally to be live by the end of this year. Going into the SEC, we're going in with exactly the type of product that, they should be excited about, which is, someone filling out the form on the website, so to speak, creating a product, working with, top tier service providers at every aspect of the fund, and creating product that should exist. Right now, a lot of the products in crypto are not necessarily healthy for the user. Stablecoins are a great example. Stablecoins burn a hole in the pocket of anyone holding them because the user earns 0% and the sponsor keeps 100% of the interest underlying the product. It's not a healthy product. What we're creating is an incredibly healthy product for the shareholders of it. The shareholders are keeping all of the return potential of the assets in the fund, and it's being done in a way that should be technology neutral. We're using, a new platform to power pieces of the technology, but not innovating on the fund itself, what it holds, or the returns or risks for the shareholders. And so, long term, I think this is something that the SEC is going to be incredibly excited about as more and more fund managers build on-chain assets, and it's hopefully done in a way in which it takes the best aspects of the blockchain with the best parts of traditional investments. Eventually we're going to have the blockchain's, speed, transparency, accuracy, automation, and composability, which are all things that any regulator should be excited about, with, a very, straightforward fund management process that doesn't add risks for what are you buying, how are you holding it, how is it monitored, how is it regulated, how is it compliant.
Robert, we're going to have to leave it there. Thanks so much for joining the show.
Thanks.
That was Superstate CEO Robert Leshner. That's it for First Mover this Monday morning. I'm Jen Sanasi. Thank you to my co-host, Lawrence Lewitton. We are going to be off tomorrow celebrating the 4th of July, so you will not see us here. We'll be taking a break, but we'll be back on Wednesday for regularly scheduled programming.
We took off for Canada Day. We have to take off for July 4th as well.
That's exactly it. In the meantime, you can catch The Hash today at noon. You're watching CoinDesk TV.
Founded in 2013, Huobi has evolved from a virtual asset exchange into a comprehensive ecosystem of blockchain businesses. With over 160 countries across 5 continents, our global capabilities enable us to provide users with safe, reliable services. Our mission is to enhance asset safety and promote financial inclusion because we believe that technology changes the world. Welcome to Huobi, your gateway to Web3.
Hey there, happy Friday. Welcome to The Hash. I'm Zach Seward. We got Adam Levine, Jen Sanasi, Will Foxley. It appears to be Denim Shirt Friday on The Hash. Let's do it. Jen leads us off with a bit of cold water about the spate of recent Bitcoin ETF applications. What do you got, Jen?
Well, first of all, I didn't get the denim shirt memo, so thanks a lot, guys.
It's not It's bro day, sorry.
Yeah, I see. I was excluded.
Bros
I get
only, Jen. Bros only.
All right. Let's talk about ETFs and some not so positive news this afternoon. The SEC says spot Bitcoin ETF filings are inadequate. The regulator told NASDAQ and CBOE that BlackRock, Fidelity, and other filings are not clear and comprehensive. This is according to a report by the Wall Street Journal. This after investors and analysts speculated that the bid by BlackRock could be a catalyst for a spot Bitcoin ETF in the US. Bitcoin tumbled below 30K. I believe it is back above. Zach, what do you make of this?
It all comes down to the surveillance sharing agreement, right? And that's what is reportedly in contention here. The SEC has long voiced concerns that the Bitcoin spot market is subject to market manipulation, and therefore it's rejected a lot of previous Bitcoin ETF applications on this ground. So the thing that got everyone all excited was that BlackRock had come to this surveillance sharing agreement with some major players in the space to make sure that they could, again, assuage some of the SEC's concerns about market manipulation and price manipulation in the spot Bitcoin market. Now, according to these sources, they didn't do it well enough. I guess it gives a little bit of room for these issuers to come back and say, no, here's how we can beef this thing up and meet your concerns. But it does sort of counteract the recent narrative in the recent weeks that this was an inevitability because we had these things in place. It sort of suggests that, hey, maybe we might see another round of rejections, which we've seen for years prior. So really interesting if these sources do indeed know this to be the case, that's really what it's going to come down to is, again, these surveillance sharing agreements that BlackRock, Fidelity, and others are baking into their applications this time around. Adam, what do you think?
Yeah, I honestly think that this is pretty fascinating, and I like it in many ways because it's kind of a lose-lose for the SEC right now. First off, it is worth noting that we found out that they were unhappy with this application like 2 weeks after the applications went in, like a week to 2 weeks after the applications went in. That's really atypical. Again, what's been normal for the SEC has been to drag these out, to delay them, and then they finally get to the spot where they can't delay it, and then they reject it. So this is kind of like, this is a little unusual just from that perspective. But look at it from the SEC standpoint, right? Through my cynical lens, which is that the SEC doesn't really want to have any spot Bitcoin ETFs, because when you have a spot Bitcoin ETF, unlike a futures ETF, it means that money that goes in to get exposure to Bitcoin is actually taking Bitcoin off of the market and is storing it in some place that, all other things being equal, actually adds demand to the equation. The SEC in the US doesn't really want that. They want Bitcoin to kind of just go away and these tokens to kind of just go away, especially Bitcoin, though, because they represent a threat in some ways. So when you're looking at these rejections, you have to kind of look at it through that lens. And when BlackRock comes and they apply and they have a track record of like 500 approvals for every 100 rejection, you kind of like the assumption has to be there that they're going to approve it, just because, again, history suggests that they will. So when you look at this situation, you're looking, again, a regulator that doesn't want to approve any of this type of instrument. And so they're looking for reasons to reject it. Now, the rejection itself was actually quite weak. To the extent that the Wall Street Journal reporting is true, essentially what they said was, hey, tell us what the exchange is. Give us more details on the surveillance agreement. So that's not necessarily like, oh, no, this isn't allowed. That's like, hey, we want more details. So I think it's great. I think it's actually very funny, and I'm quite curious to see how this plays out, because I think that the SEC is in large part trapped, where they'll have to either acknowledge that they just don't want to do this, which they have not yet been willing to do, or on the other side, they'll grant it to someone like BlackRock, and then kind of all the concerns that come along with it happen. So I think it's great, and I'm really into it. What do you think? What do you think, Will?
Yeah, I thought the same thing. Same point with the delay here was kind of odd, because normally there's a 75-day comment period where they have to like take it in, digest it, and then they can issue something. And historically, we've seen them drag it out to the end there, and then they reject it. And that's why it's taken so long historically to have these ETFs go through, right? So when we had the BlackRock one go through, we had multiple others also file, Fidelity being the latest one, right? That was a big news item last week, and it was confirmed yesterday. This issue seems to be around the surveillance agreement, according to the Wall Street Journal reporting. And I think that ties back into these market structures where Bitcoin exists on top of, right? So if you think about Coinbase or Binance or Huobi or OKX, the market makers for these markets are typically firms that tie in and start working on the back end and providing liquidity for market to trade. Sometimes, however, these exchanges do that themselves. That was a big thing with the Binance SEC lawsuit that came out the other day, was that an entity that is owned by Binance's CEO, CZ, is market making on top of Binance. And I don't think the SEC likes that. I don't think a lot of people like that in traditional exchanges where your market maker is also owned by the exchange, right? They might think that that's unfair. And so I think that is maybe what the SEC wants here, is more information about who's creating this market, where the surveillance is coming from. My understanding is that Coinbase is the one providing this information on behalf of NASDAQ, and that seems to be it. But I think they want more information to be able to move this forward. Zach?
No, I think you're absolutely right. I said Jen's hand, so I want to get her on the record. What do you think, Jen?
Yeah, I just wanted to say on the flip side, previously it's taken so many days. The entire process takes more than 200 days. And so I think that this atypical situation could mean that there is some change, could mean that there's some flexibility, and could mean that they're willing to work with those that are filing these ETFs. So I don't see it as a total negative sign just yet. And it looks like the market doesn't either. I mean, Bitcoin dipped just below 30K, but it's like it's back up. It's been there for weeks since we've learned about the filing of BlackRock's ETF. And so I'm waiting to see on what's going to happen with this one. Zach?
I'm kind of with you on that, Jen. I think that my gut would sort of be along those lines as well, right? Like BlackRock, I think, is the largest ETF issuer in the world, right? They know the process. And this seems to be part of the engagement process with the SEC, potentially in terms of getting this thing over the line. But it really does boil down to the surveillance sharing agreement, as many have pointed out, with the BlackRock application and others. All right, let's change gears. Let's talk about Celsius. Remember them, the bankrupt crypto lender Celsius? We have a little update here in that case. The plan here is to convert all the other altcoins to Bitcoin or Ethereum before distributing them to various creditors. This is interesting, I think, because there is a little bit of subtext here that at least this court sees Ethereum, or Ether, I should say, the native asset of the Ethereum blockchain, as a non-security, as a commodity. That's been sort of hotly contested of late, with Gary Gensler famously dodging the question in congressional testimony when asked if Ether was a security, given his recent comments that pretty much everything except for Bitcoin was a security in the digital asset market. So that's a little bit of the subtext, but certainly potentially some good news, I think, for Celsius creditors. I'll throw this to Adam for his thoughts. What do you make of this story?
Yeah, I mean, I think it makes sense from an execution standpoint, right? Like there's nothing that's more difficult than trying to get somebody to offload 100 different types of tokens that all use a different blockchain and all require a different wallet. A lot of people who are buying assets, again, like don't even really maintain wallets for a lot of this stuff, and they use exchanges as a proxy. Now, obviously Celsius was a little bit different, but not substantially different. So from a simplicity standpoint, it makes sense. From a market dynamic standpoint, I think it represents some troubled times for some of, especially the smaller tokens that they're holding that will get liquidated. And I'm not even really sure it's in the best interest of the kind of end users who are going to be getting some of their capital back as a result of that. Because again, like a lot of times getting liquidated out, there's taxation, there's tax consequences. Like there's just, it makes it a little bit complicated. So I'm cognizant of that, but I think that it does make sense. And it definitely, again, is an improvement relative to what we've seen in the past, where, you've got, Mt. Gox in Japan, 2013 failure, still finding its way to unwind. And in some ways that's great. Again, like the keeping your crypto as like somebody who's in a coma, that's always a good strategy. But at the same time, the lack of that liquidity can really kind of hurt. So I think this is threading the needle, and it's one of the less dumb things we've seen in the Celsius saga to date. Will?
Yeah, I take a market angle on this story. To me, the thing that popped out is the fact that Ethereum is being used as a liquidation asset here. All these other altcoins are just going to starve because the liquidity is going to be driving out of them, depending on what is in the Celsius filings as of now, and I'm not familiar with those, but all those tokens are going to be dumped onto the market, moved into BTC or ETH, and that is bullish for both BTC and ETH. I don't know how much pressure is going to put on both those coins, but the fact that we have this big holding of altcoins moving into BTC and ETH means that those two assets as denominators and trading pairs are going to strengthen, right? And that's going to drive down altcoin markets. And we typically see this during bear markets, right? Where altcoin season is far in the rearview mirror. A lot of these coins die. They have no liquidity. People forget about them, move on to different projects. But typically one or two survive and they do well. Historically, that's been Bitcoin. But over the last 3 years, Ethereum has really popped up and been a coin that, alongside Bitcoin, has been able to withstand any pressures from a bear market. Comparing 2018 and 2022, you can see that there's been a big difference in people's purview of what Ethereum is. In 2018, Ethereum fell by over 90% during that rough time, right? The coin was close to over $1,000, if not over $1,000, during the top of that market, and then it dropped all the way down to $80. This last time around, it went as high as 4,000, and I think it dropped as low as about $800, but it's rebounded to about 1,500 and held its position pretty well. And I think that's because, Zach, not only are the legal rules seeing it as a commodity, but also traders, investors are seeing it as something else than all these other altcoins that are out there. Jen?
Well, you kind of covered the question I was going to ask. I was going to ask Adam, what this means for altcoin markets starting July 1st if all of these coins are getting sold back into the market. But you answered me, so I'm going to pass it over to Zach. I
don't know. Hopefully this provides closure pretty soon to Celsius's creditors. We saw on that little screen grab that at one point, 1.7 million customers called Celsius their home for crypto, which, ouch, sorry guys. So hopefully a bit of closure for them. Again, I think the tax implications that Adam brings up about, having these assets being forced liquidated into, arguably more sound assets, but still you take that hit when you're getting those funds back out. But it is interesting to see kind of the bankruptcy process wind its merry way, right? This is something that we're going to see for a number of firms, and Celsius kind of seems to be the one that's actually progressing in the most sane fashion. So this is an update for folks. Check it out. July 1, they're talking with the SEC, perhaps a bit more clarity on whether ETH is indeed a commodity in their eyes following the release of the Hinman documents and more. So anyway, that's it for the first half of the show. I'm going to hit pause, and I'm going to look at these denim shirts that we're wearing, me and Will at least. Maybe Adam isn't wearing a denim shirt, my bad. It's okay. Fact check myself on that one. All right, enough of that. When we come back from the break, we're going to talk about Trump NFTs. This time, Melania, they love those NFTs, those Trumps. We're going to talk about that and more here on The Hash. Thanks for being here.
Welcome back. Regulation in the U.S. is a thorny subject. In fact, that's putting it mildly. Many crypto companies are pushing back, but one in particular, known as Prometheum, is taking a different approach and seemingly trying to stand out by saying that the SEC has in fact done enough, even if they haven't themselves yet secured permission to operate, and once they can operate, seem to have no significant tokens that they could actually enable for trade. Jen, why don't you start us off with this interesting story?
This is just like a web that I can't wait to see what part gets untangled next. I think the Prometheum story is really interesting. Aaron Kaplan has been very public on his stance on the crypto industry. You know, he says that if you just treat everything as a security, you won't have any issue with the SEC. He's been on First Mover twice saying exactly this. And the last hearing that he was at, you know, he confirmed that Bitcoin and Ether won't be listed on Prometheum when they are finally available to the public, and that is the majority of the crypto industry. So there's a lot to untangle here. You know, of course, there's the conspiracy theorists that feel like Kaplan, is out there projecting a certain narrative. But I think it's also important to hear the other side of the story. And I want to point to this tweet from Preston Byrne, lawyer at Brown Rudnick. He said a few weeks back, Aaron has been working on Prometheum since at least 2015, comes from a family of lawyers that has a law firm in Manhattan named for them, and has a view on tokens consistent with that background. There's nothing fishy here. It's just nobody noticed him until this week. A lot of responses to this tweet talked about, you know, meeting Aaron at conferences years back, and he's been working on Prometheum, et cetera, et cetera, et cetera. I don't know that the discussion around Prometheum, though, really gets us anywhere with regulation when we look at some of the tokens that have been in some of the previous filings. You know, they're not tokens that are widely traded or even widely known. And it doesn't get us to a place where we actually understand what securities are. You know, some of the tokens that are mentioned in the previous filings, the projects themselves have come out and said, these are not securities. So not only does it feel like Prometheum and Aaron Kaplan are defending themselves against the rest of the industry, it seems like maybe some of the token projects they hope to deem as securities as they move forward with the SEC, they'll be up against the projects that are actually issuing those tokens. So like I said, a big web, and I can't wait to see which part gets untangled next. Will, what do you think?
I think this guy is playing everyone like a fiddle. That's what I think. He went against the grain, and now everyone has a splinter in their finger and is a little upset about it, but we're talking about them, right? So go back to Preston Byrne's tweet here. He said he's known about Prometheum for years. He's known about Aaron for years. Nobody else in crypto really did, though. But now we do know about them, and we've had them on First Mover twice. They've been on Unchained podcast. They went to Congress and talked in front of everybody, getting so many different follow-up interviews, and that's going to bear fruit, even if people don't like what they're doing right now. So I think this is a very smart media strategy, and I think they're going to continue to push it. They might even agree with what they're saying with the SEC stuff, right? Like maybe that is something we take them at face value and say, like, that's what he thinks is the rule of law, and they think it's being fairly applied. But my meta take on this is a firm that is trying to build market fit in a very crowded room. And the best way to do that is to say something that's, you know, uncomfortable to a lot of people. And look how much attention they're going to get. We see the same tactic time and time again with a lot of people in crypto. And a lot of those people in crypto, not a lot of people like, because they're saying things that are uncomfortable and a lot of people don't think they're genuine. But those people often get market fit because they get attention for the first time. So that is my meta take on this whole story. Adam?
Yeah, I think that's an interesting take on it, and I think that it's a plausible take on it. But to me, the explanation here could be a lot more simple. And I think that the telling part about it is that once they actually get approval to operate, they won't be able to list Bitcoin or Ethereum. And this kind of illustrates the whole problem with the SEC's approach, which is that the SEC regulates securities. So if they are regulating an exchange, then that exchange is trading securities. And a security can be a registered security, it can be an unregistered security, but they are fundamentally securities. And the conceit that is acknowledged here, you know, by not being able to list Bitcoin and Ethereum is that not everything is a security. And by nature of not everything being a security, effectively you're separating the world into cryptocurrencies over here like Bitcoin and Ethereum, which these exchanges will not be able to trade because they're not securities. And then over here are tokens that look like securities, and they will be able to trade, but only with the constraints that are around securities, which include you can't transfer them in many circumstances if it's a Reg D exemption for a year. You can only own them or trade them or do anything with them if you're an accredited investor who has a net worth of over $1 million, not including your primary house or other kind of factors. So like that's the crazy part about it, is that this is actually an acknowledgement that what Coinbase and to a lesser extent Robinhood and other platforms are saying is correct, which is that, hey, even if we do everything that the SEC says that they want us to do, that actually would mean that we would become security exchanges and not crypto exchanges anymore. We would not be able to operate in our current core business, which seems like it's kind of a big problem for a regulator that says that everything fits within their rules. But Zach, what do you think?
Big bad Aaron Kaplan. Yeah, he's certainly everyone's favorite punching bag these days. A lot of spicy commentary around the Unchained podcast that Will mentioned with the general counsel from Paradigm. And, the lawyer on that show was basically arguing to Aaron Kaplan and Prometheum that, hey, great, you have a license, you don't have a business. And that, I think, is what a lot of people are commenting on. They're saying, well, you sure, you got this special purpose broker-dealer license, but you also entered into a catch-22 where your business ultimately may be harmed by the thing that you think is going to unlock this massive wave of investment. And I think that's a fair point. And I think that's something that people are really locking in on as Prometheum goes out there and says, hey, this is the compliant path for crypto trading in the United States. And people are saying, well, if you look into it, that's not great. You're basically saying that it can't function for the two largest assets in the market, which is a big problem. So, I would definitely check out that podcast. It's a spicy one. The general sort of tone, I think, from Kaplan and the Prometheum crew that the rest of the crypto world is a bunch of soft laws, as the Paradigm Special Counsel put it, is rubbing people the wrong way and is fueling the interest, attention, and drama around this story, as Will mentioned, whether that's going to serve them in the long run or not and simply alienate them from the community of users and potential partners. I think that's probably the big question going forward for Prometheum once it can start to be functional. But hey, who knows? Will, I think you got the last story of the day.
I do. Last comment. You can't get customers if people don't know who you are. And look, everyone knows who they are now. Okay, let's go over to the next story. If you missed out on the first wave of Melania Trump NFT, but you want to buy more, we have a story for you. They're launching the 1776 collection on Solana, $50 a piece at 3,500 unique NFTs celebrating America's history. These NFTs are coming to a market near you. Adam, you purchased a Trump NFT. Would you purchase a Melania Trump NFT?
I don't think so. I think
why?
that there's...
I need to know why. So, what's the difference between a Donald Trump NFT and a Melania Trump NFT for you?
I mean, I like doing things first, and it was funny. So, honestly, most of my investment decisions in the world of crypto follow this rubric. I will warn you and not suggest that you follow it. but this is again this is a sequel, and there's nothing wrong with sequels. But honestly, it's a sequel to a movie I didn't even really like that much. So I figure I'm going to let other people go after this one. I do think it's the questions that I have when I look at something like this really are, how much is this worth to, because with the last deal, and I assume with this one as well, these are effectively licensing deals, right? Where you have a popular brand that speaks to a certain cohort of people, which is a very large cohort of people here in the US. And people are looking for, how do you get someone involved with NFTs on the Solana blockchain for the first time, right? Polygon was kind of the last one. So it does make sense to go after these things. But my question is, what does it actually pay? What is it worth to sort of the subjects who are licensing their likeness in order to do these? And what do those deals look like? That would be fascinating to find out. We're obviously not going to, but honestly, that's like my big question about this. What do you think, Jen?
Well, there were a couple Melania Trump NFT projects. I went back and did some digging when I saw we were going to talk about this story, because I remember the eyes one, but there was another one in between, and then there was she auctioned an NFT and it sold for a bunch of money, but then a report came out that said it with a wallet that was actually attached to her that purchased that. So Melania's been, being very crypto. Yeah, exactly. Melania's an undercover degen here, and now she has a new NFT collection. I wonder who's going out there and buying them. I mean, they are only $50, and you can get them with a credit card when you click on it. So maybe there are Melania fans who are going to learn a little bit about the Solana ecosystem by buying these. But Zach, I see you smirking over there, and I saw your hand up, so I know you probably have a spicy take on this.
First of all, we need to make Will do all the NFT story intros, because yesterday's intro was an all-timer. He's like, do you like lawn art and NFTs. We have the story for you. And he just did that on this story as well. So I think we need to make that happen. This is like the future of fan engagement, as like silly as it sounds, right? This is all it is. It's fan engagement. The Trump family has a long history of licensing their likeness to be on various forms of merchandise. This is like us kind of talking about like whether or not like the Trump family like presidential like dinner plate is a really cool thing. We're just NFT and crypto nerds. So we end up talking about it as though it means something. But really it's just a tchotchke. And some people want to have a digital tchotchke. Others would rather have it on their dinner table to look at, or maybe in the fine china closet that never opens but has a glass window in front of it. So this is really kind of think what this is. And I think it is something that ultimately supports the long-term use case for NFTs sticking around, right? Commemorative items are a big business. They're not sexy, exciting, or even worth commenting on most times, but they're here for the long haul and they probably bring in a lot of money in aggregate. So the fact that we're seeing this with NFTs makes a ton of sense and actually is bullish that some of these mainstream figureheads are being like, well, yeah, we did it once. Let's try it again. Let's see what happens. And maybe that is going to be like why NFTs stick around, is because people like tchotchkes, even digital ones. Got to give it to Will. Close us out. What do you think about this one?
I got a few thoughts. I'll leave it with the first Trump NFT stack did really well, but when he released a second, it was not great for hodlers of the first one. So perhaps in this case, we see a repetition of the past. I'm not saying short these NFTs, but it's not looking great for any Trump NFT holders out there. The market is looking a little sour, but we can close out there, Zach.
Well, when the Baron Trump NFT drops, guys, get ready. That's going to be hot. There we go. The man is tall. All right. That's it for the show today. That's it for the show this week. We're The Hash. I'm Zach Stewart. That's Adam Levine, Jen Sanasi, Will Foxley. Thanks so much for being on CoinDesk TV with us. Check us out as well on the CoinDesk Podcast Network. We wish you a happy weekend. Have a great one out there. Thanks.
Welcome to Forecast IQ. As the world accelerates into the digital economy, we're going to help you stay ahead with the latest in Web3, crypto, and of course data. This is where we look beyond just the headlines to get you the insights and knowledge that will help you power smarter decisions. I'm Forecast's editor-in-chief, Andy Lau. Well, when it rains, it pours, and it's pouring Bitcoin ETFs, which appear to be the hottest bet in town. Fidelity, the investment manager with over $11 trillion US dollars of assets under management and 40 million customers, is once again trying for a Bitcoin ETF in the United States. On Tuesday, the block reported Fidelity is close to filing its application for a spot Bitcoin exchange-traded fund, or ETF, with the SEC. Now, Bitcoin prices jumped briefly to $31,000 on the news Tuesday evening in Asia before retreating. Now, Fidelity had filed for another Bitcoin spot ETF in 2021 called Wise Origin Bitcoin Trust and rejected by the United States Securities and Exchange Commission in January of 2022. So why try again just weeks after the SEC called out crypto in its expansive filing, calling it most securities? Well, Fidelity already sells a Bitcoin exchange-traded product in Europe, which is 100% backed by Bitcoin. That's in custody of Fidelity Digital Assets. And now it appears a race is emerging. There has been a spate of Bitcoin ETF applications in the United States from TradFi giants like BlackRock, Invesco, and WisdomTree in just the last 2 weeks. While some experts see this as a sign of rising interest in digital assets, Michael Silverberg of crypto fund Altab Capital says, while ETFs are more convenient for many types of investors, that doesn't make them better. In other words, exposure to crypto doesn't make it crypto. Tuesday also marked the launch of the first leveraged Bitcoin futures exchange traded fund called 2X Bitcoin Strategy ETF, offered by investment advisor Volatility Shares. The ETF is listed on the CBOE in Chicago, the largest options exchange in the United States, under the code BitX. Now, the ETF won't be investing in Bitcoin directly, but is focused on making gains from price changes in Bitcoin futures contracts. All right, speaking of ETFs, customers of HSBC Hong Kong can now trade, Bitcoin and Ethereum ETFs. According to Decrypt, ETFs are now listed on the bank's so-called Easy Invest mobile app that it has for its retail customers. The app offers exposure to Bitcoin and Ethereum futures based on derivative contracts that trade on commodity exchanges. CSOP Bitcoin Futures ETF, CSOP Ethereum Futures ETF, and Samsung Bitcoin Futures Active ETF are now available on the HSBC Invest app, according to the report. All right, now, since we are on the subject of Hong Kong, one of our favorite places, of course, the Special Administrative Region has been moving swiftly to bring regulatory clarity to crypto. We've told you about that. But now this, a landmark ruling from the city's high court has recognized cryptocurrency as property. And some believe the decision could have wide-ranging effects on the regulation and taxation of the digital assets in the region. Forecast's Jenny Ortiz has this report.
Earlier this year, in an unprecedented move, the Hong Kong High Court acknowledged cryptocurrency as property capable of being held on trust. This landmark outcome on March 31st, resulting from a judicial skirmish surrounding the defunct cryptocurrency exchange Gatecoin, is expected to reshape the landscape of digital asset regulation and taxation in Hong Kong. The ruling was given by Justice Linda Chan, who held the view that cryptocurrency ought to be regarded as property because it can be owned, transferred, and has inherent value. In a statement sent to Forecast, fintech lawyer Christy Swartz of DLA Piper said the ruling confirms crypto assets do not exist in a lawless realm, and holders of these assets are protected under Hong Kong law. This is echoed by law firm Detchert's Michael Wong.
When you actually buy a piece of cryptocurrency, you can go to the court and enforce your proprietary rights of that currency against whoever. So I think it's a good sign.
Gatecoin was wound up by court in March 2019, with liquidators appointed after a failed attempt to recuperate disputed funds from a previous payment service provider. Following the closure, Gatecoin's liquidators sought legal advice on how to classify the cryptocurrency held by the exchange. The court had to decide whether it should be treated as property held on trust or be made accessible to a general body of creditors. Jason Chan of Detchert told Forecast several jurisdictions have also earlier decided on a similar issue.
This case really follows, a long line of other common jurisdiction cases. For example, England, Australia, Singapore, Canada, and New Zealand, and even in the US, they all kind of already recognizes the crypto as property.
Meanwhile, Swartz added, the Hong Kong ruling is likely to serve as yet another persuasive authority for courts who have to decide on questions relating to property rights associated with crypto assets.
To be honest, I think Hong Kong, in terms of the approaches, I think they're moving in the right direction. And the more regulations they've published, the better for the industry because it provides certainty. It tells people what you can do, what you can't do.
As Hong Kong moves towards its goal to be a global crypto hub, regulatory clarity on what is a cryptocurrency is precisely what's needed. Jenny Ortiz, Forecast.
All right, great stuff there from Hong Kong, Jenny. Shifting gears to Singapore, last week the Lion City Central Bank gave an in-principle go-ahead to payments network Ripple Labs application for payments license. Rahul Advani, Ripple's policy director for Asia Pacific, joins us right now to break down this landmark development for the company and to dig a little in on the details. Rahul, great to see you.
Thank you for having me, Angie. It's a pleasure to be here.
All right, congratulations on the in-principle approval for a major payment license from the MAS. So tell us, what does this mean for Ripple's operations in Singapore and the Asia Pacific?
It allows us to offer regulated digital payment token products and services, which will enable us to better support and scale the use of on-demand liquidity, or ODL, by our customers in Singapore and across the APAC region, and that are looking to explore blockchain and digital asset technologies for their cross-border payment and treasury use cases. With on-demand liquidity volumes surging in Asia Pacific, we know that there's great appetite from customers in the region to engage and explore with blockchain and digital assets. And this obtaining the in-principle approval of the major payment institution license to better support these progressive customers and scale our ODL services to ultimately build a more inclusive and borderless financial system.
Okay, right. Rahul, so how does Singapore then fit into Ripple's global operations?
Singapore's location makes it a prominent gateway to emerging markets in Southeast Asia, as well as developed markets across the Asia-Pacific region. We're a global business, and we remain hyper-focused on building our teams outside of the US. About 90% of our business is global, and Singapore, and to a large degree, the broader APAC region, is one of our fastest growing regions and remains high on our list for recruiting.
You know, at the start of the year, there was speculation that Ripple's case with the US SEC will be settled by mid-year. Well, we're here now. Can you give us an update on how the legal case is unfolding?
We continue to push for a speedy resolution, and we look forward to proving that Ripple did not violate securities law and that the SEC never provided Ripple with fair notice that its actions would ever be prohibited under the law. The decision and timing is ultimately up to the judge. We don't have any control over that.
Okay, lastly, Rahul, I got to ask you about this. Ripple acquired digital assets custody firm Metaco for $250 million. It's $250 million US in mid-May. Can you give us an update on how that integration is going, and how does it fit into the global strategy for Ripple?
So acquiring Metaco makes Ripple the leading enterprise solution provider in the space. Both Metaco and Ripple share strong, digital asset and crypto DNA. So this is the first of many offerings as we continue to build and invest in crypto infrastructure.
All right, Rahul, thank you so much for joining us on the show. Really appreciate it. All right, everyone, time for a quick break, but we will check in on cryptocurrencies and the NFT markets when we come back. Stay with us.
Forecast News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. We go to where the action is, from Asia to the world. Forecast is the most reliable source of intellectual discourse and insight that informs, educates, and bridges the gap between the blockchain industry and the mainstream. The future is being built, and Forecast has it covered. This is Forecast News.
All right, welcome back to Forecast IQ. I'm Forecast Editor-in-Chief and your host, Angie Lau. It's great to be with you, and thanks for joining us. It has been an interesting week for crypto. We saw Bitcoin hitting levels not seen in over a year, even as ETH, the largest altcoin, gave up about 4% in the last 7 days as institutional interest racks up. So how are market experts playing this out right now? We've got Justin Dathinen, Head of Business Development at KeyRock, and he's here to talk about just that. Justin, it's great to see you.
Hey, Angie. Thanks for having me on.
All right, let's kick off with Bitcoin ETFs. The first leverage Bitcoin futures ETF, as we said, just started trading this week. What is it exactly? How are futures ETFs different from spot Bitcoin ETFs?
I have a very negative view when it comes to futures ETFs. I think they're very inefficient instruments because there's a lot of infrastructure and cost required to buy, hold, and roll over futures, whether they're done on a monthly or quarterly basis. And so it almost means that by definition, you're going to underperform the price of the underlying that doesn't require those costs. But of course, the whole point of an ETF is how accessible it is to institutional investors, professional investors, and also just retail if they have access through an app or a platform or a broker, right? When you talk about spot ETFs, they're a lot more complex because there are security concerns, regulatory and compliance concerns that the regulators, at least in the US and in many actually jurisdictions, can't really wrap their heads around. And that's why it's so hard to get spot Bitcoin ETF.
Yeah, it's interesting to see how institutional players remain pretty optimistic about Bitcoin ETFs, as we've seen with BlackRock and Invesco and WisdomTree, and of course now Fidelity, even as retail investors are still slightly wary. What are these institutions seeing that maybe the average retail investor isn't yet?
I don't necessarily think it's a difference between a perspective on the asset class or the space itself, between retail and institutional investors. I think they just go about the space in a very different way. When you're an institution, you're going after an infrastructure or a product that caters to that market and to investors.
All right, Justin, let's shift away from ETFs. Let's take a look at the markets right now. I really want to talk to you about this. Bitcoin sitting around the $30,000 mark, even though a lot of people predicted that it would be between 25 to 30K for a little while longer. So what's your take?
Sure. So Bitcoin has performed very well in the past 7 days on the back of all the positive news we've had. We might keep on going up if people are still enthusiastic about it and if the macro environment itself remains positive, but things change very quickly in crypto in general, right? So I think it's too soon to say fundamentals are all rosy and positive and we should all be buying Bitcoin. But right now, at least, the fundamentals are definitely very positive, and so there's no reason why Bitcoin couldn't stay or even go higher than 30K.
Justin, always a pleasure speaking to you. Really appreciate it. Thanks for joining us. All right, over to the world of non-fungible tokens, NFTs, as you know them by. Bitcoin Ordinals protocol has emerged as quite the fierce competitor to Ethereum NFTs in June. 4 out of the top 5 NFT collectible sales in the last 30 days were on the Bitcoin chain. And as you know, we track BTC Ordinals on cryptoslam.io. Let's get in our very own Yehuda Pesher to break down that nitty-gritty of the NFT market. Yehuda?
Sentiment across the NFT ecosystem continues to be positive as traders' optimism is stoked by bullish crypto news. A majority of NFT trading happens over on Ethereum, where the price of Ether is threatened across the 2K mark. So why am I mentioning crypto? Well, NFTs and crypto are closely tied, but you won't typically see them running together. When crypto is running up or down, NFTs typically stagnate, and that's because the price of crypto affects the price of NFTs pretty significantly. On the flip side, buying an NFT whose price could drop the moment you buy it, well, that's not ideal either, so buyers are also sitting out. Established Ethereum projects, collections like Moonbirds, CloneX, and Doodles have fallen to all-time low points, but even still, NFT traders are feeling optimistic. That's largely because of the art scene and because of some exciting announcements in some of NFT's biggest projects. Azuki's Follow the Rabbit event in Las Vegas last Friday saw the project's founder Zagabond deliver another check your wallet moment. And this year's announcement delivered them NFTs from another new collection called Elementals. The impact of the announcement saw a decrease in Azuki's floor price, but following days saw Azuki's average sale price increase to one of its highest points since March, when it reached $46,000. The new Elemental collection will likely have an impact on the Forecast 500 NFT index because collectors may want to liquidate existing assets they hold across other collections to get a stake in this new Azuki collection. Plenty of others are having a very rough stretch. That's including the Bored Ape Yacht Club, who continues to see falling prices as the narrative across the NFT community focuses on the collection's falling floor prices, reached as low as 33 ETH. Large Bored Ape holders like Machi Big Brother and Franklin together have sold over 60 Bored Apes. Other whales taking their mid-tier apes and they're listing them at the floor, and that's leading to savvy traders scooping them up and quickly flipping them for profits. The discounted price has also led to a new anonymous wallet going on a shopping spree. Some exciting news is taking place over in the gaming world. Gods Unchained arrived on the Epic Game Store last week, bringing the NFT-based card game to a huge new audience. Though to say it's a new game isn't entirely accurate, Gods Unchained is actually one of the blockchain's oldest video games, being born on Ethereum in 2018 before migrating to its current home on Immutable X. That's for scaling purposes, and it seems like a very wise move at this point. Mythos Chain's NFL Rivals also made new this week as the free-to-play, officially licensed NFL mobile game crossed the 1 million download mark. Just as noteworthy is players are averaging 2-hour-long play sessions. These are all remarkable achievements considering it's the NFL offseason, so we'll see how this ecosystem grows once the upcoming season kicks off in September. And a history lesson to close things out. So Yuga Labs is publishing a book on the historic CryptoPunks collection, and this book will detail the collection's history as being one of the primary inspirations for almost everything you see in the NFT space today. The book will feature insight from some of the collection's most noteworthy collectors, including Beeple, Def Beef, and Snowfro, although there is backlash among the punks community from members who have been staples in the community and have helped grow the community for years now, who have so far been left out. That's a wrap on the NFT markets. I'll see you again next week with another market update.
Always interesting in the world of NFTs. Yehuda, appreciate that very much. Thank you for joining. All right, on that note, let's take a quick break right now. We're going to focus on how crypto is faring in the world's most populous country. We are talking about India. Don't go anywhere.
Forecast News is your gateway to all things blockchain, breaking down and breaking through the noise with the people who know it best and why it matters. The future is being built, and Forecast has it covered. This is Forecast News.
All right, welcome back to Forecast IQ. We're going to talk about crypto in India right now. It's been a rough spot for the better part of the past year. We've got regulatory changes, taxation, and market movements, and it's all impacted the crypto landscape in the South Asian country. Forecast Pradeepta Mukherjee takes a closer look at where the industry stands today.
It's 100% speculative activity, and I would still hold the view that it should be prohibited.
The message from India's central bank is clear. Crypto is not welcome in the country. India's crypto story can be traced back to 2014, when the nation's first crypto exchange, Unocoin, was set up. As digital assets rose in popularity, Indian entrepreneurs spotted a new opportunity. And over the next few years, local cryptocurrency exchanges, CoinSwitch, CoinDCX, and Zirex were set up. Matic Network, which later went on to become the Polygon blockchain, was created in Mumbai in 2017.
The building scene is still quite vibrant in India. Of course, there are certain, say, startups which have left, in the sense that they have now set up in some other jurisdictions. But still, majority of them still work and stay in India.
In 2021, India introduced the cryptocurrency bill. 2 years on, the bill has yet to become law. Anand Purushottam of Crypto Legal told Forecast it is likely that we will see a new version of the bill this year, and the outcome will depend on India's discussion with the G20.
And a lot depends on the kind of deliberations that G20 member states are actually going through. So once we have some clarity on what members under G20 think about it, they are also likely to release a report soon, probably in 2-3 months. And that report of G20 is likely to, in my opinion, shape the kind of crypto bill that we'll see in India.
While digital assets were not officially banned, regulators were clamping down through enforcement. In the 2022 budget, India introduced a 30% flat tax on all crypto income and a 1% tax deducted at source, or TDS. This had an immediate impact. Crypto exchanges saw trading volumes drop as much as 90% from July last year, and over $3.5 billion of crypto trading moved to offshore crypto exchanges, according to one estimate. Earlier this year, India also expanded the scope of Prevention of Money Laundering Act, or PMLA, to include digital assets, which requires crypto exchanges to conduct due diligence and report suspicious transactions. India's Financial Crime Fighting Agency, the Enforcement Directorate, has been investigating at least 10 crypto exchanges for alleged money laundering and has seized over $115 million so far.
This taxation is kind of a regulatory tool that the government wanted to use to maintain a status quo. And this status quo becomes very important because, say if we look at the timelines, then tax was imposed last year in March, and that was the time when, though even now we don't have cryptocurrency specific law.
While India has been bearing down heavy on crypto, it sees value in the underlying blockchain technology. Speaking to Forecast, Raj Kapoor, founder of India Blockchain Alliance, said various industries are adopting the technology.
What we do promote is the adoption of the technology, that's blockchain, and the distributed ledger technologies, and everything which flows with it, that is the metaverse, the NFTs, the DeFis, and the Web3s, all that's coming inside now.
The South Asian powerhouse has also been working on developing its own CBDC called the e-rupee, which the central bank sees as a game changer.
CBDC is the future money. Large number of countries are working on CBDCs. Technology is becoming more and more robust in this area. We cannot be left behind.
Countries' leading banks, including HDFC Bank, ICICI Bank, and Kotak Mahindra Bank, participated in a CBDC pilot launched late last year. The e-rupee trial tested both wholesale and retail payments. And just a few weeks ago, 6 Indian banks and JP Morgan launched a pilot to try real-time dollar settlements using JP Morgan's Onyx blockchain. India is also using its presidency of G20 to push for greater collective oversight on crypto assets and markets. Moreover, digital payments have taken the country by storm. Even street vendors proudly display QR codes for payments.
I don't think it's really a question of survival in the sense that, at least personally, I don't think the taxation regime that is applicable today will continue. And it's kind of a transitory provision where once the regulatory part is clear, then there will be a rationalization, and probably we'll see at least some form of tax benefits given to the ecosystem.
The future of the whole entire asset class is going to be tokenized. Today we have tokenized real estate, we have tokenized bonds, we have tokenized, we can tokenize green carbon credits, we can tokenize anything which is an asset. The next 5 to 10 years will see a major paradigm shift from the way things are today to getting tokenized.
Could crypto then be the next step in the country's fintech journey? Will we see clearer regulations and a well-defined crypto ecosystem develop in India? Or will crypto firms be pushed further into the shadows? Well, we will surely keep a watch. In Kolkata, India, I am Pradipta Mukherjee.
Well, that's a wrap on this week's show. It's always great to be with you. Remember to like and subscribe to this video if you're watching us online. It helps us get to you and get all of those insights to you better. Or stay tuned right here on this channel if you're watching from home, the office, or really wherever you are. We really appreciate the time that you've spent with us. It's easy to stay connected with Forecast for the latest developments in the world of crypto and Web3. I'm Forecast Editor-in-Chief and your host, Angie Lau. Join us again this time next week as we bring you the latest from the world of Web3 and why it all matters. Forecast IQ. Get intelligent in Web3.
Good morning, happy Friday, and welcome to First Mover, your first global look at today's action in Bitcoin, blockchain, and digital assets. I'm your host, Jen Sanazzi. My co-hosts, Lawrence Lewitton and Emily Parker, are off today. And so Myself and the amazing technical team behind me are the only suckers working this long weekend, but we have a great show for you. Let's take a look at what's going on in the markets this morning, starting with Bitcoin. The Bitcoin price XBX index is at $31,003. Going up again after some Fidelity news when it comes to Bitcoin ETFs. We'll talk about that in just a little bit. Let's see what's happening in Ether. The CoinDesk Ether price ETX index is at 1,907, up over 2%, following the same trend as Bitcoin this morning. Let's see if DeFi assets are following suit. The DFX CoinDesk's DeFi index is at 112, up almost 7% this morning. All right, let's talk about that Fidelity news that is moving markets this morning. Fidelity has refiled paperwork for its Wise Origin Bitcoin Trust, joining the wave of spot Bitcoin ETF applications after BlackRock, Invesco, and WisdomTree. Joining us now to discuss is CoinDesk Global Policy and Regulation Managing Editor Nick Day, who's also the editor of CoinDesk's State of Crypto newsletter. Good morning, Nick.
Good morning and happy Friday.
Happy Friday. All right. We're gearing up for the long weekend and we have another Bitcoin ETF filing. This is Fidelity's first application since it was rejected in January 2022, right after the SEC said no to Bitcoin ETF applications from First Trust and Skybridge Capital. What happened then? What are they doing now? Why is now the time for this flurry of applications?
To answer your last question first, honestly, I think now's the time because BlackRock did it. And I think everyone's got this assumption that BlackRock has a pretty good record, right? It's had exactly one ETF rejected out of nearly 600, I believe. So, it seems to be the idea is, well, if BlackRock's doing it, clearly they think that there's some compelling reason. But what's really interesting to me is we haven't seen much change in terms of the actual underlying Bitcoin spot markets that might warrant change, right? So if you look at all the SEC rejections from years past, and there have been some pretty lengthy, explanations of why they've rejected some of these spot Bitcoin ETF applications, and they come down to a lack of surveillance sharing agreements with markets of significant size. So basically, the SEC is saying that there's no spot Bitcoin market that is regulated enough, that is secure enough that it can prevent market manipulation or other issues from occurring on the overall market. So I'm really curious to see what's changed because that hasn't changed. There's no spot Bitcoin market that's regulated by the SEC at this point, or even the CFTC, that screams, okay, well, this is definitely what the regulator is looking for a Bitcoin ETF application.
Could there be something in this surveillance sharing? So recently we saw Cathie Wood's ARK Invest amend their spot Bitcoin ETF to include the service sharing agreement. This is similar to the language used in the BlackRock filing. Is there something there maybe?
Yeah, that definitely addresses one of the SEC's big complaints that they haven't had these surveillance sharing agreements in the past, or if they have, that the markets that they've set them up with weren't significant or regulated enough to satisfy the SEC's concerns. So that definitely seems to be what these companies are saying they've solved. BlackRock, Fidelity, even as you mentioned, Cathie Wood's company. They all seem to think, okay, well, we figured out how to set up this kind of surveillance sharing agreement with a market that should meet the SEC's needs or demands. But again, I'm really curious to see what markets they choose, because at least as of today, June 30th, 2023, we haven't seen any of these markets really come into place. Now, the one thing that might be the case is these companies might be thinking, okay, well, the SEC started to bring lawsuits against crypto exchanges. Perhaps there will be a more regulated spot market by the time they get to the end of the review period. Which could be as long as 240 days from whenever the SEC first acknowledges them. So that might be what they're anticipating, and this is just kind of a first swing at something they expect to see in place in the next couple of months.
I think it's important you bring up that more than 200 days number. This isn't something that's going to happen tomorrow. There's a process here. And as we saw on that graphic that was flashing on the screen just a moment ago, there have been 30 tries so far, according to some data. Talk to me about the next steps in the application process. What can we expect?
So the thing we're looking for right now is the SEC's formal acknowledgement that it is reviewing these applications. That's going to kick off the first 45-day review period, at which point the SEC will have the option of extending or approving, disapproving the application. My guess is, and this is what the SEC has done with every single one of those applications before, is they will extend the review period to go through the full 240 days. But right now, all we've seen are the initial forms filed by the issuers, so by BlackRock and Fidelity. What we need to see is the SEC post on their website and on the Federal Register a document saying, okay, well, we have received this thing, we have begun looking at it. That could happen, soon. It could take a few weeks, but generally it follows pretty quickly from once the first form, the 19B4, is filed.
Any indication from your reporting, from a regulatory perspective, why there's so much excitement around this when these ETFs exist in places outside of the US? Like, is there just hype around this, or from a regulatory perspective, is there something here that we should be watching more closely?
Well, companies have been applying for Bitcoin ETFs for years now, and the argument has always been that if you have an ETF structure, it lets people gain access and exposure to Bitcoin without having to actually buy into Bitcoin. So if there's concerns about, for example, things like security, or for people who don't want to deal with their own wallets, or for, companies or, accredited investors or, sophisticated investors who want some kind of security and assurance about what they're investing in, but don't want to, or can't deal with the actual Bitcoin market. In theory, this will provide them with access. Also, Bitcoin ETF should be, accessible by anyone, really, any kind of retail trader. So, show up in your TD Ameritrade account if you want to. So basically, security is one thing, and then the ease of access and accessibility is the other thing. A lot of people just really want to see whether or not there will be mainstream interest in Bitcoin through an ETF structure, where there might not be if they're stuck trying to buy Bitcoin on their own wallet and self-custody or trusted custodian or anything like that.
All right, Nick, we are going to leave it there. Thank you so much for joining us this morning, and I hope you have a great weekend.
And you.
That was CoinDesk Global Policy and Regulation Managing Editor Nick Day. Don't forget to sign up for the State of Crypto newsletter on CoinDesk.com. Joining us now to discuss the crypto market's reaction over the spot Bitcoin ETF race is the CEO of institutional DeFi asset management company Hashnote, Leo Mizuharo. Welcome, Leo.
Hi, Jennifer. Nice to meet you.
Nice to meet you too, and thanks for joining the show this morning. Now, I have to get your take on the Fidelity refiling. We just unpacked it a little bit with Nick, but what's your take on the ETF and the market's reaction?
Yeah, I think the refiling is super interesting. As you guys know, this is the second time Fidelity has filed, and being on the back of BlackRock, WisdomTree, ARK Invest, VanEck, I think this is really showing this demand for this product, and the market reaction is similar. It's showing that a ETF in the space would definitely support Bitcoin price. I think one thing that might be worth noting here is, to some extent, all of these institutional providers all applying for this ETF at the same time almost acts as a challenge to the SEC's decision-making process here. Clearly, these are real investors. These are BlackRocks and the Fidelities of the world think this is a reasonable thing to have on the market. And clearly, many other regulators have also thought the same thing. There are Bitcoin ETFs in Canada, Europe, Brazil, Jersey. There's a lot of precedent for thinking that these are reasonable securities. And so I think this is it's interesting to see this wave of investor demand for this product that the SEC will have to come up with reasonable reasons to accept or deny.
I'd love to get your opinion on if you think that this is going to be accepted, given the big names that have filed. Given what Nick Day just told us, not a lot has changed in the U.S. since the last filings were rejected by the SEC.
That's right. It's really hard to tell, actually. I have no information on this particular likelihood of these being accepted. However, as the market matures, I think the likelihood of one of these passing only increases. It almost starts to look unreasonable as players even as big as BlackRock are starting to file the same claims.
We've seen Bitcoin hold above 30K and hit 31K in the last 24 hours, as we saw at the top of the show. Do you think the market is going to sustain this as we get more clarity over these ETFs?
I actually do. I think that this upcoming I think we're out of the lowest of the bear market. And I think this next wave, this next cycle is going to be really driven by institutional investors. At least that's my thesis. And this wave of ETF filings very much supports that thesis. And I think we'll continue to see more and more institutional adoption of Bitcoin first, but then eventually other cryptocurrencies, and eventually also more of the DeFi ecosystem.
Today, Bitcoin options contract worth roughly $4.5 billion expired on the Deribit exchange, which controls over 85% of the global options activity. It's also the end of June. We're halfway through the year. What are your expectations for July?
I think July is going to be a relatively quiet month, although no months are ever quiet within crypto. But I expect a steady grind. I think we've seen a very consistent upward trend since March, and I'm looking to continue to see positive headlines and positive movement out of this ecosystem. There's a big conference happening in Paris mid-July, and generally speaking, conferences where people have shown new technologies and new products within the ecosystem have been very positive for the market.
And does your positive outlook pertain to Bitcoin and DeFi assets? I know you haven't been on the show every day this week, but Bitcoin has held steady. DeFi, our DeFi index has kind of been up and down. Both are positive this morning. Talk to me about those two elements of the markets. Do you see them moving in the same direction?
Yeah, Bitcoin has been outperforming because of the level of institutional involvement and this positive hype around the ETF. And I think that's very well deserved. Bitcoin is definitely going to be the biggest asset for a while in terms of institutional adoption and just general market knowledge, I think. I do think that it'll also continue to prop up DeFi and the reasons for the public to use the DeFi ecosystem as well. In particular, I've been watching a lot of the altcoins have been hit over the last month or so, particularly after the SEC filings, but almost all of them have recovered at this point. And I think that's a very positive sign, despite there being not that much news around them. And so we're seeing people really support that ecosystem and understand that not all of them, even if they're deemed securities, not all of them are going to be not unviable at that point.
All right, let's talk about this PCE data that came out just before the show started. The Federal Reserve's preferred inflation gauge came out. The PCE index increased 0.1% in May. What's your reaction to how inflation is impacting the wider crypto market?
Yeah, inflation and kind of the broader macro ecosystem in general is very impactful, particularly for Bitcoin. I think we started to see it we've started to see it diverge a little bit from the general macro, given the positive news. However, it is going to be a risk-on asset for a while now. So I think seeing tame inflation is always going to be positive. We've seen inflation come down pretty strongly over the last year, back down to really within range of what the Fed's going to be comfortable with. So the Fed being on pause and inflation no longer really looking like a threat is going to be only positive for crypto in general.
Now, I've asked almost all of our markets guests this week, but economists are calling for a recession either by the end of this year or by Q1 next year. How do you think this is going to impact the crypto markets, if you think it will at all?
Well, a recession is never good for any risk asset, right? But easier money, if the Fed starts to cut, will certainly be good for both crypto and the tech ecosystem. I also am not certain, though, on some of these calls for a recession. Many of them are predicated on this gut reaction of higher rates means recession coming soon, and I don't think that's the right conditionality, although there's definitely some correlation there. We are seeing a very strong market, a very strong economy, despite the fact that rates are high. The fact that we see this low inflation and low unemployment regime, even now with rates at 5% plus, I think it's hard to say that we're going to get a recession that quickly with such a strong economy going on.
All right. And lastly, back in February, Hashnote was the first company to be launched by Web3 incubator Cumberland Labs. Hashnote is also regulated in the US by the CFTC. Where do you see the future of institutional grade decentralized finance headed?
Well, I think generally, historically, finance has been very good at ingesting new technologies. And DeFi and this whole crypto blockchain thing is going to be no different. We're seeing adoption from many of the major financial firms in a variety of ways. We've recently seen a resurgence of money market funds on chain, particularly from Franklin Templeton and the like. We see experimentations from guys like Goldman Sachs and JP Morgan all the time. And so I think it's only a matter of time before we ingest all this technology and make a new financial system that's really driven by blockchain technology. And that's what we're doing at Hashnote. We think that because the future of finance is going to be driven by blockchain, having an investment manager that is blockchain first really is going to be an advantage as more and more of these assets go on chain. I think it's as inevitable as the electronification of equities markets, for example, which may have looked crazy to people in the 80s, but now we can't imagine a financial market that's not fully electronified and traded on the internet.
Anything that you think needs to change with regulation to achieve this future you just described?
Oh, almost certainly, right. That's the one thing that everyone is terrified about, particularly in the U.S. It's really a shame to see so much talent going abroad, as many of the other jurisdictions are actually quite positive on blockchain technology and crypto. We're seeing a lot of positive developments in Europe post-MiCA. Hong Kong is trying hard to attract talent at this point with their new regulation, and the Middle East is very positive and very proactive in trying to attract crypto talent as well as crypto money. So I am quite optimistic still about the U.S. being able to change course. I think we have a history of making great last-minute decisions, and so we're awaiting that as we set up shop and are expecting the U.S. to eventually make the right decisions, and perhaps do so in a very cautious manner. But with the type of money at stake, I think caution is a perfectly reasonable way to enter this market.
All right, Leo, we're going to have to leave it there. Thanks so much for joining the show this morning, and have a great weekend.
Thank you very much, Jennifer. You have a good weekend too.
That was Hashnote CEO Leo Mizuhara. We're going to take a short break, and when we come back, new details are out surrounding FTX's latest bankruptcy deadline. We'll discuss with an expert in the distressed crypto asset market next.
The State of Crypto is presented by Tron, connecting the world to the power of cryptocurrency.
Could FTX come back to life? The infamous crypto exchange is talking to investors about a relaunch. This is according to a report from the Wall Street Journal. Joining me now to discuss is 507 Capital Managing Partner Thomas Brazil. Welcome to the show, Thomas.
Hey, thanks for having me.
Thanks for being here. Now, according to this Wall Street Journal report, current FTX CEO John Ray said the company, quote, has begun the process of soliciting interested parties to the reboot of the FTX.com exchange. Talk to me about what you think about this as an FTX creditor yourself.
Yeah, I think it's good to see them following all possibilities for recoveries, whether that's through litigation and, the regular sort of what are called preferences and fraudulent transfers and as well as marshaling assets. But then, going concern value is always more than liquidation value. So it's good to see them at least entertain the idea, even though I do still think that it would be a bit of a tall order for them to do. It's good to see this exercise happening.
Okay, you say it will be a little bit of a tall order. What do you think is the likelihood that something like this comes to fruition?
Well, it's looking increasingly more likely. So the probability has gone up over the course of the bankruptcy. But I would say it's still probably below 50% probability. If you really made me put a number, I'd probably say maybe a 20 to 30% chance. I think what the debtor is going to do is they're taking proposals from parties in the market who could actually run this business, and that means equity in the new company for creditors. That's fantastic. We would be supportive of anything that we think maximizes creditor recoveries. But if someone's just going to show up and run the estate and get free optionality on the back of creditors, we would not be in favor of that. So the details are very important.
I know I'm asking you to speculate a little bit here, but any inclination, any ideas who these investors might be, who these interested parties might be?
Yeah, I mean, it would be a who's who of, crypto firms. I mean, I had heard the Figment floated around. I heard the Wave Financial guys name float around from a few parties in the background. These are all guys that were looking to do things with, probably with Voyager and definitely with Celsius. So it's the same parties that are, you see it in every cycle, when you have downturns, or every industry, when you have downturns and you're in a strong position, you look to consolidate and you look for business opportunities. And so it's not, it's anybody with cash and with the team to be able to potentially do this.
Yeah, I mean, everything we're talking about makes sense here. Do you think that the brand is able to revive itself?
Crypto I guess crypto investors maybe have short memories. No, I think that if it's confidently run with some capital put in by whoever the sort of plan sponsor is, in the same way that Celsius was run, their sort of plan is contemplated to be done, then we would be supportive, and I think that would be great for the estate. But yeah, again, it's still a lower probability. It's just good for the estate to see it out. And I hope I answered your question there, but I rephrase it if I didn't.
No, that was perfect. We introduced you as an expert here. You started buying Mt. Gox bankruptcy claims back in 2015. 507 Capital is a major buyer of claims like FTX, like we've spoken about, 3AC and Celsius. Talk to me about the marketplace for buying and selling claims like this.
Sure. So just a tiny bit of context. I started getting involved in Mt. Gox, and we started buying claims and have been a major buyer of claims across almost every crypto insolvency, and not just claims, but we've looked at doing what are called debtor in possession loans, any sort of litigation finance, or anything that might be interesting. So at the end of the day, we're in this ecosystem, and we're believers long term in the ecosystem, and that's why we've put a stake in the ground that we want to be a part of these restructurings. because long term the ecosystem has to grow for us to benefit. So yeah, the market in general, there's a pretty active market for FTX. I would say Celsius, there's a pretty active market. Voyager, not as much, and Three Arrows, not as much. And then there are a number of tertiary dockets that people don't probably talk about that really aren't so active. But it's good. The American process for bankruptcy is great because in FTX there is a lot of disclosure, and so that allows buyers to be able to really get under the hood and understand the process of what the recoveries might be long term, and therefore offer decent compensation to people. And it also helps the seller get comfortable that they're not being hoodwinked into selling. Like they feel like they know what's going on in the case. So
I have to ask you, given your experience, about a new product that hit the market recently by 3AC founders Kyle Davies and Suzu. They launched OPNX. They're tokenizing bankruptcy claims. Do you think there's a future for a product like this?
I do. Not sure if it's the right team to be doing it, but I definitely think that the idea of tokenizing bankruptcy claims is super cool. Much less incremental than the idea of maybe a marketplace. Not that there's anything wrong with a marketplace. The marketplace is fine too. But I think innovation in the restructuring space is great. And it's nice, it's unfortunate for creditors that are caught up in it. But let the competition begin for creditor assets and eyeballs to be able to monetize their claim in any way they can.
Some might say these two co-founders understand bankruptcy better maybe than the rest of us.
Yeah, I don't know. No comment. I don't know what to say to that. I wish them the best. I think it's great for creditors to have just more options. It can't hurt.
All right. I want to talk about something you tweeted yesterday. You tweeted a line item from John J. Ray's expense report. It shows the current FTX CEO is researching treasury investments and cash options. Explain what that means and why it matters.
Well, I guess if rates are at 5%, 5% on $4 billion or whatever, $3 billion, whatever the cash holdings are at this point, would be fantastic for the estate because it could help with the administrative burn. But in U.S. bankruptcy, and I'll say I'm not a lawyer. I just reinvest in these, so I think I'm saying it right. When you're supposed to be an FDIC insured accounts, so for him to basically go and do treasury management, he'd have to motion for the court to get approval for whatever they were doing. But there is huge cash balances, and they are just sitting around. They should be invested in a conservative, but it wouldn't be wrong, a prudent but conservative way. I don't see why they wouldn't be looking at this. So it's nice to see. I think people have talked about it for a while on Twitter and other places. And look, I had the opportunity to meet John in person a few weeks back, and he was fantastically great and candid. And I think this is just more of John being John, which is trying his best to increase recoveries for creditors.
Thomas, thank you very much for joining the show today. And I hope you have a great weekend.
You too. Thanks for having me. Have a good weekend.
That was 507 Capital Managing Partner Thomas Brazil. We're going to take a short break, and when we come back, we'll reveal the top places in the world to live and work in crypto, blockchain, and Web3. Find out what those are when we come back. Good morning and welcome back to First Mover on CoinDesk TV. Zug, Singapore, and London ranked the highest in CoinDesk's crypto hubs list this year, which details the best places in the world to live and work in crypto. Joining us now to discuss how these rankings came to be is the CEO and co-founder of IOMob, Boyd Cohen. Welcome to the show, Boyd.
Thank you, Jen. Nice to be here.
Wonderful to have you on this Friday morning. Now, you consulted with CoinDesk to create these rankings. Talk to us about the methodology. What went into scoring and rating these cities?
It's always a tricky prospect, and it's always going to be contentious, the results. And this was the first time we ever collaborated to build this. So it's going to be a learning process for all of us as we move on to future rankings. I actually, in the past, used to do smart cities rankings for Fast Company, and that's kind of how the conversation got started about collaborating. Worked with the team at CoinDesk over, 6 months or so. And we applied. So I have a background in academics, although I've been working in crypto now for 6 years, and have actually visited or been to events at almost all of the top 15 in our list. So I have some context. We went through kind of a blended process that's somewhat academic and then very practical. In the end, you have to be a bit practical when you do a ranking like this, because there's so many different ways of capturing the data and using the data to actually try to come up with a credible ranking that people would actually, accept on its face as being a neutral, credible result. And in our case, what we did was stage one. We reached out to experts we knew globally, and we specifically sought out people in less obvious places too, so that we had a more holistic approach to this. And the first question was, name the top 20 cities in your opinion, or regions or hubs, because we define it as hubs. So the idea was, you never know. There are areas in the world where it's not just a city, but maybe a region or like a couple cities combined that are creating like the Silicon Valley for crypto, right? So we use that kind of process to get from subject matter experts a list of cities to start with. And then we looked for, out of the 20 or so experts that we got good responses from, we looked at where there was overlap, as in this region or hub has been named by at least two of the experts we reached out to, and that formed the basis of the starting point for the ranking, followed by a collective exercise to choose the indicator that we should select, and then find data that was accessible and acceptable to represent those indicators we wanted to capture.
Okay, so definitely a thought out process in putting this list together. You said you visited all of the countries that
most of them.
Most of them. Any cities that you were surprised to see make the list?
Well, for sure. I mean, I think I barely knew anything about Ljubljana until we did this ranking. So that was one that surprised me. We had some that were maybe not surprising, but didn't make the final cut that I was happy to see in the first list, but didn't make the final 15, like Lagos in Nigeria, Buenos Aires, El Salvador. Again, going to that point that I think, increasingly, and it's even interesting, some of your prior interviews today regarding sort of the regulatory environment, the approvals of ETFs in the US, is kind of interesting to juxtapose. You've got the US market, which did, some people view the rankings as, well, the US did pretty well, because like 6 cities in the US made the top 15. But when you look at most rankings of cities for innovation, usually the US is dominant, right? And in here, I think the first city ended up, the US city was 8th. So every other cities from around the world before US cities appeared. And that is because of the regulatory environment. Whereas you find in some of these more developing countries and cities like Lagos and others, you have a much more favorable environment. El Salvador, where they actually of course used Bitcoin as legal tender.
Talk to me a little bit more about how regulation played into the scoring here. We just saw a graphic that had the weights for the scorecard. How important was regulation when putting this list together?
Yeah, this was something we debated internally. I mean, obviously, any ranking, selecting indicators is already a challenge. And then deciding the weighting of those indicators is another challenge. And we had a lot of debates about it, but in the end, for us, it was just so critical, the regulatory regime, because without it, you really just don't have a solid foundation for a vibrant crypto ecosystem. Whether you're a startup, whether you're a venture fund, whether you're a digital nomad, if you have a antagonistic relationship with the regulation bodies around crypto, it's really hard to have a flourishing crypto ecosystem. So, you could argue that it is surprising that there were even 6 cities from the US that made the list, or North America that made the list, given the frankly terrible regulatory environment you find in the US, compared with, and one of your previous guests just talked about it, Abu Dhabi, Dubai, Hong Kong, Singapore, so many cities and regions are really taking a leadership, London, taking a leadership position on not saying we're going to regulate by enforcement, but we're actually going to embrace these kinds of initiatives, this kind of innovation around crypto, and we want to attract the world's innovators around crypto. And there's that recent story with Andreessen launching an office in the big venture fund in London, and one of their biggest rationale was specifically the regulatory uncertainty in the US versus the certainty around it in the UK.
Wrap this up for us as we go into the weekend. What does this list of cities tell you about the state of crypto on an international stage?
What I actually kind of love about it compared to most traditional sort of innovation indices is how decentralized and democratized hubs of innovation around crypto are. I think if you looked at most tech industries, you would see more bias exclusively in the Western world, particularly Europe and North America. And what I love about crypto is by default, by its design, it is a democratizing technology. And therefore, we're having these hubs emerge all the way down to Lagos, to El Salvador, and of course to Dubai and other markets. That's what kind of has me the most excited about the future, is that we're not like putting all our eggs in the basket of Silicon Valley, but instead seeing flourishing ecosystems all around the globe.
Boyd, thank you very much for joining the show this morning.
Thank you, Jen. My pleasure.
That was the CEO and co-founder of IOMob, Boyd Cohen. Head to Coindesk.com to check out the rest of the cities that made our crypto hub list this year. That's it for First Mover. I'm Jen Sanasi. Thank you so much for coming and joining us this morning. It will be off for the weekend, but back on Monday. I know it's a long weekend for most, but we'll be back right here on July 3rd. In the meantime, you can catch the hash today at noon. You're watching CoinDesk TV.
Hey there, welcome to the Hash. It's me, Zach. I got Jen Sanasi. I got Adam Levine. We're on CoinDesk TV. That's pretty cool. CoinDesk Podcast Network, also super cool. Check it out. Good stuff. We're here to talk about today's news in crypto and more, and I'm going to kick it straight to Jen for the first story of the day. Jen, what do you got?
All right, we got some more developments with FTX. According to a report by the Wall Street Journal, FTX is moving ahead with plans to restart its international exchange. CEO John J. Ray III is quoted in the article saying that the company has, quote, begun the process of soliciting interest parties to the reboot of the FTX.com exchange. Sources say the company has already had early talks with investors about different structures, including possibly a joint venture. Adam, I'm going to kick this one off to you. Seems like FTX 2.0 could be on the horizon. What do you make of this?
Well, I think it makes sense just from the perspective of if you were going to try to get value out of this brand, then this would be the way to do it. FTX, although it had a pretty abrupt fall from grace, really was a top exchange for a good amount of time, not necessarily for folks in the US. We weren't really allowed to use it, much to my chagrin at the time. But in hindsight, that turned out to be pretty all right. The reality, though, is that if they can reboot it, then there probably is substantial brand value to be had there, and that could wind up being a better way to recover, much of kind of the losses that appear to have been incurred here for folks who have funds trapped in there. It could also work out well for the company as well, because it likely would mean that not just kind of beyond the restarting, that there would be some type of equity allocation that would actually go to people who are owed money by the exchange. And so that could then allow the company to keep kind of more liquid capital and go from being something that just gets liquidated, down to nothing, to pay off what it can, to instead continuing as a going concern. Which would be better for some of the parties who are involved here. So I think that it makes sense. I think ultimately it'll be hard to pull off. There's a lot of challenges around trying to reboot this type of brand in this type of situation, but it makes sense that they would try. Zach?
Yeah, a lot of people who used FTX really liked the interface, right? They liked the UX, they liked the functionality. People were fans of it. Whatever was going on behind the scenes wasn't evident to them. The massive dumpster fire that apparently was FTX and Alameda wasn't apparent to a lot of users who really sang the praises of the trading interface at FTX. So the idea that they would kind of roll out that technology certainly makes sense. I think it shows some forward thinking by John J. Ray III, JJ Ray out here launching things despite maybe some initial skepticism that's whatever come to pass. I know we expressed a lot of that skepticism on this show previously. So if this ends up being the case, I mean, yeah, hats off to him for trying to get money back into the system and pay out people who were harmed by what appears to be, or what is alleged to be, a pretty massive fraud. So yeah, it's going to be interesting to see. I think the thing that I'm most interested in is which backers back FTX 2.0, which venture funds sign up, sign their name on the line, put their name next to the FTX brand and say, you know what, we're doing it. We're going all in. There was some fans of this product in the past, and we think we can breathe some life into it in a way that makes sense. That to me is actually going to be the interesting thing. No names were mentioned in the piece, but reportedly at least, JJ Ray is making the rounds and saying, who wants to back this thing? I'm very curious to see who that ends up being. Jen?
Yeah, the piece said that parties that want to be involved must submit indication interest by the end of this week. So if you're watching and you want to be a part of this, you have until Friday. And the piece also said that Figure is allegedly interested in helping FTX restart. You'll remember that they bid on the rights to Celsius, but lost to the consortium that won that bid. So interesting. I am also very curious to see who could get behind this, but it sounds like it's probably, Adam, to your point, one of the better ways to get funds back into the hands of customers, to give customers some kind of something that can make up for what's happened over the past year with FTX. I see Will Foxley has joined us. Will, what are your thoughts on the possibility of FTX 2.0? And welcome to the show.
Thank you. Thank you so much. I don't know what you guys just said, so I might just be repeating it, but that's okay. I'm going to still say it with enthusiasm. I think they should relaunch FTX 2.0. I hope they do go along with this. Why? Because there's a lot of creditors involved with this, and maybe everyone who's involved here can get some money back. We've seen all the other stories of failed exchanges, right? People get like 10 cents back on the dollar, 14 cents back on the dollar. Well, what if there's a world where FTX is able to reboot itself and pay back everyone the full amount of their money in USD terms. That's a pretty fantastic ending, though a very unlikely one. I know there's a lot of people on crypto Twitter who are pushing for FTX 2.0. They're like putting it in their bios. They're putting in like their handles saying like, we want this to occur. It's typically people who obviously lost a lot of money and are well down like the creditor stack and are unlikely to get money because all the money goes to people who had loans out to FTX or are lawyers working on the Chapter 11 case. So that's what I'm cheering for. I think there's a place for another exchange out there. It's sort of like the Ledger news yesterday with the institutional trading firm that they're trying to boot up. There is a vacuum right now. After FTX left, a lot of liquidity left the market. A lot of people didn't know where to trade. Coinbase is under siege. Binance is under siege. I think it's prime time for another person to step up and build an exchange that a lot of people can use. Did I repeat anyone's talking points? How was that?
That was highly value additive.
Supported our
Coming
points.
in blind. That was nice.
That was really good. It's professional. I will say that. I wonder how regulators are going to use the narrative. I know there will be probably no validity to saying something like, FTX failed customers. There was like massive wrongdoing behind the scenes, and here we are, FTX is back again. I can see regulators saying that. I can see them using this narrative to push regulation that may maybe is not favorable to the industry. Not saying it has any validity. To it, but I can see that happening. Separately, customers have until the end of September to submit bankruptcy claims. So I just want to get that in there. If you were a customer of FTX, you should be receiving a link to submit your bankruptcy claim, and you have until the end of September to do that. That is my public service announcement to the people.
Very nice.
Thank you, Deb. Okay, cool. Let's move on to our next story. So next up, publicly listed exchange Coinbase continues to battle allegations from the U.S. securities regulator, which has accused the company of exposing users to what the SEC alleges are unregistered securities. A security, whether registered or not, is essentially a contract with obligations laid out and defined in at least basic terms. And that is the crux of Coinbase's argument for why the SEC is in the wrong here. Quote, because no such obligations are carried in the transactions over Coinbase's secondary market exchange, and because the value that Coinbase purchasers receive through these transactions adheres to the thing bought and traded rather than in the business that generated them, the transactions are not securities transactions, end quote. This is a somewhat controversial take, just because, again, in the world of cryptocurrency, there's a lot of questions about what really is security as it relates to the Howey test. Zach, I'm going to throw this one to you first. Kind of what's your read on this argument? Is this a strong argument for them?
I think it's a very interesting legal tack. I think what you laid out, right, is that tokens don't guarantee an ownership stake in the projects that ostensibly launch them, right? They exist, they do their thing. There's no public disclosure requirements in terms of how these alleged securities would disclose that information to investors. So Coinbase is saying, hey, this isn't what you think it is. It does not exist within the existing purview, and you've failed to establish clear rulemaking and instead have chosen enforcement. So that I think that's honestly the crux of the argument, and is an interesting argument. It's going to be an interesting one to advance through the courts and to see if judges are sympathetic to this argument. And whether or not the U.S. securities regulators have done their due diligence in trying to establish a framework for what these other things will be regulated as. Gary Gensler obviously has maintained that just because it's a new technology doesn't mean it's not going to be covered by existing securities laws. And Coinbase here is saying, no, that entire premise is wrong and faulty. And how that's all going to get arbitrated in court is going to be really fascinating. But yeah, interesting to see this as the initial volley. Wouldn't have necessarily expected that this would have been the approach, but certainly it's a strong statement. That's what I'll say. Will, I'll toss it to you.
Yeah, I actually kind of disagree with Coinbase here. I think that some tokens that they've listed are not securities, but some of them do fall under the parameters of what a security would be, even if they use different language and wording. Let's take, for example, a governance token. There's a lot of governance tokens listed on Coinbase. You're able to purchase them there. These governance tokens basically have one purpose. That is to govern the function of a DAO that controls the network. And these DAOs purpose is to streamline the network, adopt more users, and generally increase the price of the token. It's like a classic flywheel for these things. And that's been well known for a lot of these projects. You need that. And I actually don't disagree that that's not a good use case for these tokens. I think a governance token can have good place. But if it quacks like a duck, I think you sort of get the picture, right? Like there could be some problems here. Now, not all the tokens that are listed on Coinbase are that. I think some of them are like that. So I sort of take a different stance. I just think like the Howey test in general is like an old, outdated law and can be changed based on the fact that, things have changed, technology has changed, and there's probably a better way of enforcing regulations than what they're doing currently. The other thing I want to bring up was the Coinbase, part of this Coinbase article was talking about how they don't like the enforcement actions that have been taken to date. Quote, for years, Coinbase has voluntarily submitted to regulation by multiple overlapping regulatory bodies, has adhered to the public and limited formal guidance from the SEC, senior SEC staff, and the courts about the application of securities laws to its industry. They're basically taking another stance within this argument saying, not only do we think the securities laws are wrong, but we've tried to listen to you guys, and you guys have not helped, and therefore this whole thing should be thrown out in the first place because you're going against your own guidance. Which to me is like almost like a 1-2 punch, like coming at them, but also sort of helps some in the back case that, whoever is the judge here disagrees with Coinbase on the securities point, but maybe we'll agree with them on the fact that the SEC has not been following through with their enforcement actions in like a healthy way. Gonna throw it over to Jen.
Yeah, I think it's a good argument. And Will, to your point, I mean, there are all of these tokens that exist and there is the theoretical use case for it, but then there's how people are actually using that token. And we need to take all of that information into consideration. I think what this highlights is there's the Howey test. It's been used in one way by the SEC for a really long time. But when applied to this industry, maybe there are aspects of the Howey test that are left up for interpretation, which then means the Howey test maybe is not the best tool to use if it can be left up to interpretation. And I think Coinbase's response to this shows just how it can be left to interpretation. Like we're discussing it right now. We're taking different things away from how the Howey test is being applied to different tokens that Coinbase lists. And I think that's a good thing to highlight. Zach?
I guess the big question, like as it relates to Howey, is are tokens the contract to the orange farm or are tokens the oranges, right? Right? Are tokens an investment contract or are they just merely something that maybe was initially involved in what may have been an investment contract, and therefore it doesn't necessarily sort of comport with like these existing structures, right? And there's a lot of fuzziness and a lot of questions around that. We've seen a big debate spring up over the launch of Prometheum, which got a special purpose broker dealer license to trade in digital asset securities, but hasn't really offered much detail into how that would actually work in terms of the investor protections and other things set forth by current regulations. So this conversation is really fascinating. For Coinbase to zig in this direction with their sort of initial statement, it's just going to make for some really interesting viewing, I think, in terms of this brewing SEC crackdown legal/regulatory fight that's obviously being played out on multiple fronts right now. So yeah, another fascinating move to see. I'll stat.
Yeah, I mean, I think we can wrap up with, I'm comfortable making a prediction here, which is to say that we're going to see this mess continue probably for another 1 or 2 years. And then I think Congress will eventually act in a way that sort of puts this to bed. I agree with the point that like Howey is the tool we have, not the tool that we need, and kind of the all of the deficiencies with that standard in kind of the modern era, close to 100 years later, I think about 90 years later at this point, like that's where the challenge comes into play here, is just that we're using a standard that was designed at a time before we understood a lot of stuff that's like on the basic science level, much less kind of the modern era of technology. And so this will eventually get solved. But in the meantime, it's kind of fertile ground for sort of these power games that these regulatory agencies play. Where basically their own sort of self-aggrandizement and their importance to the current narrative Like if the SEC wasn't focused on tokens right now and they weren't focused on cryptocurrencies, who would care about what they were doing? Who would think about what they were doing? Why would they get more money to any of the stuff that they're doing? They wouldn't. So this is actually, again, like there's some meaningful incentive in here for them to make the argument that, hey, this is all about us and you better fund us more, right? Give us some more power so that we can protect from this, even if that's not really the fit. But the beat goes on.
And the beat goes on into the break. We're going to take a break, and then we're going to talk about some other stuff, including the MFers NFT collection at Lowe's. Can we even say that? MFers at Lowe's on a flag? That's kind of an interesting development in the world of NFTs. We'll talk about that with someone involved in the project and more on the flip side of this short break. Stick with us. It's The Hash.
And welcome back to The Hash. Are you a fan of lawn art and NFTs? Well, this segment is exactly for you. We're talking about MFers, which is a new project that integrated with Lowe's in order to put the MFers PFP on lawn art. Pretty interesting development here. We have Matt Varnell of Total Marketing Web3 joining us now to talk about it all. Matt, first of all, welcome to the show. And second of all, how did you get Lowe's to go along with this? Interesting development for the NFT space.
Yeah, thank you guys for having me. Very excited to talk about the project. My very excited to talk about the project. My IRL job is product development, marketing, sourcing. I've been calling on Lowe's and other big box retailers for about 18 years now. So, it was a perfect. It was a match made in heaven. Been a Bitcoin guy. Going back to slightly late, but about 2020. That transitioned into NFTs, discovered the MFers. What really intrigued me about the project was the CC0 aspect of it, to where it's essentially public domain. Satoshi when he put out the project, did so in the manner where MFers can do what they want with it. So you can take it, you can put it on product. MFers can do what they want with it. So you can take it, you can put it on product. It's open to anyone to use that for whatever means they see necessary.
Okay, I have to ask you, does Lowe's know what MFers is? Like how how did this conversation happen? Like, how did you get the flag to be sold? On the Lowe's website?
So if you go into a Lowe's store today and you shop garden flags, I'm actually responsible for their everyday seasonal business, right? So there's a line of communication, seasonal business, right? So there's a line of communication already established there. This transitions from season to season. You have your holiday winter, you go into to spring, summer, so just fall, and then kind of circles back around. So that line of communication was there. I'm always, I'm constantly having meetings with the merchant team. This idea to sort of test the test the theory of can Web3 help push, whether it's the marketing, the sales, the engagement. In the right direction. It basically took them trusting me, believe it or not, to make this thing. It basically took them trusting me, believe it or not, to make this thing The buyer himself didn't have a history. In NFTs, crypto, so to speak. So basically, in NFTs, crypto, so to speak. So basically. I said, trust me on this one. Let's see what happens. This is a test. And I got the green light. So yeah, it was it was A lot of selling on my side, to be quite honest with you.
Yeah, so that
selling on my side, to be quite honest with you.
Yeah, so that makes total sense to me as far as how this would happen. Thank you for the additional context on that. I'm super curious about the CC0 connection here, kind of in all of this stuff. Again, like CC0 is something that's been getting trendy sort of in the world of NFTs. Stuff. Again, like CC0 is something that's been getting trendy sort of in the world of NFTs. And basically it means that they retain, the owners retain no rights and anybody can really do whatever they want. That seems like that's kind of a double-edged sword, though. And can you talk about how you you're thinking about kind of the CC0 component and whether this is something that you would look to be doing more in the future, perhaps with other brands?
Yes, I would say absolutely. Absolutely. From our perspective, it's more about the entire community. of MFers and NFTs really as a whole from the CC0 standpoint, right? So what we've discovered is